Good morning, everyone, and welcome to Investor Expo show for May 7th. My name is Anna, and I'll be your host today. We are having a great lineup of four speakers for you. Michael Valtos, for the first time on our show, Kit Harwood, Troy Noonan, and Dr. Barry Burns. I would like to begin and bring to the show our first guest, Michael Valtos.
Today, I'm going to be talking about, you know, what I call hidden trading opportunities. And, most traders, I say most traders, majority of traders strictly look at one aspect of the market, which is price. But there's other underlying things in the market, like volume, that help you determine, really what's happening in the market. And I'm going to show you how you can use those different pieces to find what I call hidden trading opportunities that other traders just don't see in the market because they're not necessarily looking at that information. All right, so hey everyone, good morning on this Thursday. It's the Thursday before Mother's Day, and it's really starting to feel like spring, and the summer's coming up. So, it's a good time to, really jump into the markets. Before we would always think, well, school's going to be ending soon and I'm going to be spending a lot of time with the kids. But now we sort of have this new normal where the kids are at home and we're trying to juggle, work and school and, everything else that goes on in the house at the same time. And, it's a great time to expand your knowledge on the markets, right? Because we're at home, can't really go out anywhere. It's unfortunate the price of gas and oil is so low that you can't really travel anywhere. So it's a great time to catch up on your education of the market. So today I'm going to be talking about uncovering hidden trading opportunities with order flow. And what I'm going to show you is hidden trading opportunities that other traders miss, how to use those hidden trading opportunities to get an edge over other traders, and how to use it with order flow. Right? You're going to find these with order flow, and it's going to be very quick and to the point. For those that are new to my presentation, my name is Michael Valtos, and I've been in the market since the early 90s. And just a brief background on myself. I started at the lowest level in the industry. I started as a runner with Dean Witter Reynolds, back on the CME floor. And eventually, after about 2 years, I realized electronic trading was really starting to take off. How can I get into, the electronic trading aspect of it? And I had the opportunity to join what they called the Globex trading desk at Dean Witter Reynolds, which is basically, all the electronic exchanges at the time. CME had Globex, CBOT had Project A, Comex, NYMEX had Access. And then also at that same time, because those markets were only open during the overnight session, I also had access to all the rest of the world's exchanges, Eurex, Life, well, it was DTB back then, not Eurex, the Asian exchanges, Cymex, Tokyo, and it was really an eye-opening experience for me. After that, after about 3 years, I left there and I joined EDF Man, the big English trading company, on their global macro desk, again, to trade all sorts of commodities. Then I was hired by Commerzbank to be their Eurex trader based in Chicago, right? So I traded everything that was on the Eurex against the US products. So German Bunds against the US 10 years, Babel against the 5 years, DAX against the NASDAQ, and E-minis. Then after that, I joined Cargill, right? The big American trading company. And I spent 4 years there. I was a trading desk manager. They sent me to Singapore to set up a trading desk even after about 2 years in Chicago. So after that, I joined JP Morgan. I spent 8 years as vice president of futures trading. And it was a trading job, right? It wasn't where I was just sitting on a corner office looking at spreadsheets, come out and say, hey, you know what, you're trading too much, et cetera, calm it down. No, banging away at the keyboard monkey for 8 years, basically. But after that, I got tired. I was in my early 40s and I said, there's got to be more to life than just working 12 hours a day. And so I left JP Morgan. This is a nice job. And, spend more time with my family. But, after about a year, I got itchy and wanted to get back into the markets. I was trading for myself during that time. And I was using the order flow software, which was okay. But, I realized that software can do a lot more than just plot a chart, right? So in 2015, I created the order flows trader, which is for NinjaTrader 8. It's a volume footprint chart, right? But what I did is I took my forms of order flow analysis and I put it into the chart. So the order flows trader, as it has evolved over the last 5 years, now has 7 pre-programmed order flow indicators. And the charts that I use in this presentation are generated with order flow trader software. And the neat thing is, let the computer do the work for you, right? This is 2020. Okay, this is not 1998 where you're just happy to have a plain chart. No, the computer can do a lot of the analysis for you. And what's nice about the order flow trader software, the volume footprint chart, or any volume footprint chart for that matter, is it takes all the information that's generated by the exchange, the volume traded on the bid, the volume traded on the offer, and puts it into a nice, easy to read format so that analysis can be performed on it. Excuse me. Now, in around 2015, 2014, 2015, I started writing my book on order flow, right? I wanted to give a contribution to the trading society. So I wrote this book called Trading Order Flow. And it's a 150-page book. If you stick around to the end, I'm going to give it to you for free. I'm going to show you how to download it for free off my website. So before I jump in, a brief disclaimer. Basically, only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Now, I got to go through a couple basics, because you can never stress the basics enough, right? Whether it's basketball or trading. And with order flow, you have to start with what I call three building blocks, right? Because all of the rest of order flow analysis stems from one of these three or a combination of all of these three. And it's delta, point of control, and imbalances, right? It's like having different little blocks, but when you put them together, you could build something. You could build a trading plan around it. So just really briefly, delta is the difference between aggressive buyers and aggressive sellers in a bar. And it's important so you know who is dominating the bar. Now, every bar has a delta, and most software, mine, for example, puts it along the bottom of the chart. There's also internal deltas. I'm not going to get into delta today, but this is one of the building blocks from which you can build a trading plan to trade the market. Now, the second thing is point of control. And point of control in the bar is the price level with the most volume. And what's beautiful about it is there's no fancy mathematical formula to determine it other than simple arithmetic. You take all the volume traded on the bid side, all the volume traded on the offer side, and that's your point of control for the bar. Every bar has one. I have just a few arrows here, but every bar has one. You see the rectangle around the bar. And what that tells you is the area where the most volume's traded in the bar. And you could sort of take it a step further. And once you realize that's the area where most trading occurred in the bar, that in a loose sense is your value area for that bar. Now, the third piece is imbalances. A market imbalance occurs when there are more aggressive buyers than sellers, or vice versa, more aggressive sellers than buyers in the two-way auction, right? Remember, the market is bid and it's offered. It's 28.27 and a quarter bid at 28.27 and a half. So that's the two-way auction. And buying imbalance occurs when there's at least 4 times as many traders buying the offer than traders selling the bid. And conversely, a selling imbalance occurs when there is at least 4 times as many traders selling the bid than buying the offer. Now, I say 4 times, that's sort of a guideline, right? There's some people that use 10 times as much, some people that use 3 times as much. Sort of the industry standard is 4 to 1. And think of it like this, all right? You have a seesaw. Well, the side that's more heavier, in this case more aggressive, is the side that's going to win. So how it looks on an order flow chart is in the volume footprint, right? You have red numbers, you have blue numbers, you have black numbers. Black numbers is your normal trading that is occurring. A red number is going to be your selling imbalance. It's going to appear on the bid side. A blue number in the bar is a buying imbalance. It's telling you there's more aggressive buyers at that price level in the two-way auction. Okay, so why does that matter is because generally as a market rises, you see buying imbalances. Aggressive buyers are lifting the best offer and looking for the next best offer. Demand is present, right? Think of that. Buying imbalances generally equate to demand. Now, when a market falls, you see selling imbalances. Aggressive sellers are selling into the best bid and looking for the next best bid to sell into. In this case, supply is present. All right, so now that you have those basics, right, let's jump into the hidden trading opportunities that can really transform your trading. Now, you know, traders, when they're new to the markets, they always stumble across things like this, right? The candlestick cheat sheet, right? If only trading was this easy. Oh, well, you have this pattern, you buy, you have this pattern, you sell, right? What they don't really talk about sometimes is, they don't talk about context. And context often comes into, market structure as well as volume. So, I'm going to show you, I pulled examples from yesterday, right, to show you that these opportunities appear daily, right? I'm not going through weeks and weeks of charts to pull out, the one picture perfect one. This is all yesterday. This is all E-minis. This is all 1-minute charts. Be consistent. Sometimes I do presentations and I show people, a 1-minute chart, a 5-minute chart, a 1,000 tick range, 5,000 volume, and then people get confused, like, oh my gosh, I gotta have so many charts. No, I do that to show you that the same concepts apply on different charts. But for today's purposes, I'm going to keep it uniform, 1-minute charts, E-minis, just so you can see that, how often these appear. Okay, so here you got a nice bullish candlestick pattern, right? The market should rally based off your handy dandy, candlestick cheat sheet, right? So you're going to be looking to buy, right? You're expecting the market to go up. Well, what happens? It didn't go as expected, right? The market sold off, 20 points basically. And the part of order flow that really stands out is understanding what's happening in the market. And you can see, right, this red candle right here with the arrows pointing down to is what gave it away. Now, if you're looking at a normal bar chart, you can't really tell. By the time you get to the big red candle and you're stopped out, yeah, it's obvious that this market isn't going up, but at this point, it's too late already. You already stopped out, you already took your loss. But if you had bought off of this bullish candle pattern, by the time you get to this red bar, by the time it closes, you should really be looking to get out now before this big down candle happens and stops you out if you're long. And that's where the beauty of order flow comes in. And what do we see? In this red candle here, right? The blue box I drew there, this pink box around this bar is telling me two things. One, I can see there's a stacked selling imbalance in here, right? You see this red zone here. You see 11 against 16, 59 against 3, 161 against 16. You have 3 selling imbalances stacked neatly on top of each other. It's called a stacked selling imbalance. Now, the order flows trader software will put a pink box around any bar that has 3 or more imbalances, whether they're stacked or not. As you can see, there's a pink box here. There's 3, well, there's a stacked buying imbalance of 3, and then there's another buying imbalance here. And you can see down here, right off the low, right, you see 1, 2, 3 buying imbalances in there. That's how you can use software to take the information that you're seeing in the market and go deeper into it, right? Take that information. Okay, well, yeah, there's a lot of bids and offers in here, but what does it mean? Well, when you start putting it together, well, I've got 1, 2, 3 buying imbalances right off the low of this move. Do you think that's bullish or bearish? Well, it's most likely bullish, right? And you see how the market has rallied up a little bit. All right, so sometimes trying to figure out which way a trade is going is like this, trying to figure out which wire to fix, right? It's confusing because oftentimes you get a lot of different potential trading opportunities. So, for example, right, candlestick patterns, basically, would you buy here? Well, yeah, you got a bullish Marubozu candle pattern, right? So you should be buying it, right? Well, it doesn't work. Okay, so you got another pattern at a new low. Well, you got a doji candle pattern or spinning top. Some people will argue, right? Okay, well, yeah, that's potentially bullish. Okay, well, you try to buy that, you get stopped out. Okay, then you get down here, you get to this new swing low. Well, uh, it's not really a candle pattern. I spent 20 minutes last night going through a lot of my candlestick books, seeing if I could find this pattern. It's not really a pattern. Okay, closest I could find is an inverted umbrella. These Chinese candlesticks, they got all these wonderful names, like 3 white soldiers, black crows, etc. There's a bit of romance tied to them, but you know when they work, fantastic, but oftentimes they don't work. There's been studies, I'm not gonna get into it, but there's been a lot of studies on different candlestick patterns. Um, and to find the best ones work about 65% of the time. But even that, out of a month, you probably get 3 trades or something like that, 4 trades. So it's not very practical in that sense, right? So if you got 3 choices, right? You got A, B, and C, right? A started to work out a little bit, went up a little bit. B, nah, just went up and immediately came down. And C, well, they're all basically bullish patterns, but it's C is the one that caused the nice reversal from basically 28.50 all the way up to 28.75. But what was there in the order flow, right? Now, point A, it's a trade I like to take. Honestly, we've got 3 buying imbalances in the bar. The market did rally up about 4 points before turning around and starting to come down. This is one that you could have taken a small loss or broken even on. Okay, fine. Those trades happen. B, never, right? There's nothing in the order flow that's really outstandingly bullish. C, we have what's called an imbalance reversal. Okay, you can see this green arrow pointing up here. This is the beauty of the software is it does the analysis for you. It tells you there's an imbalance reversal. Now, people are going to ask, well, Mike, what's an imbalance reversal? Okay, well, imbalance reversals occur when traders are trapped in a market, right? They're long and wrong. They're short in the hole. The 2 expressions people like to throw around. Ask yourself, how many times have you sold the low of a move or got long at the high and you were trapped, right? Think about it, right? Market's coming down. You finally think, this market, I've been buying A, I bought B, the market's turning around, making new lows, sell it, right? Then you sell down here, it's the low of the move, market starts creeping back up, you're kicking yourself, you turn off your machine, I'm an idiot, I'm not trading anymore. That's an imbalance reversal. You're basically, you sold the low of the move, you got long at a high, you're trapped. Now, the beauty of the software, right? You could have the software do this analysis for you, so you don't have to sit there and split hairs. Is this a reversal? Is this not? What's the point of having a footprint chart if it's not helping you analyze the order flow, right? There's so many footprint charts out there. It's just a plain footprint chart. There's so much information that's coming through in the order flow. Let the computer software analyze it for you and tell you something is happening. And again, this is just yesterday, right? I'll give you a couple more examples. Here's an imbalance reversal, a bearish one, right? This red arrow right here, right? You can see the market, again, had a nice sell-off from, the 68, 70 area down below 60. Okay, again, this is all on E-mini 1-minute chart. Here's a market that's moving higher, right? You got your imbalance reversal here in this bar, this blue box here. Well, I drew the box to highlight it. It's this little green arrow here. And you see as the market continued higher from 64 all the way up above, 69, 70. Again, all on 1-minute E-mini charts from yesterday. Traders see what they want to see, not what's actually there. Eyes plays trick. I always say the eye plays tricks on you because oftentimes, we have a bias. We come into the market, we have a bias. And there's times like this where you sort of get conflicting signals. Okay, you have a double top. You got a pin bar in the middle here, which is bullish, right? You got these long wicks under these bars, which is bullish. This double top is bearish. What do? You could sit out, you get long, do you get short? You're going to be asking, okay, this market has been trending up. Are we pausing here just as we paused earlier? But then we're going to make a new move higher. Or is the market getting ready for a reversal? Other traders will say you got to wait for confirmation. Well, why wait, right? Look at what's happening in the order flow to tell you potentially which way the market's going to go. If you look at the order flow, it becomes a lot clearer. It's pretty bearish. Okay, you got 2 points A and point B. Point A, you have multiple selling imbalances in the bar. They're not stacked, so you don't see stacked selling imbalance in the bar, but instead you see 1, 2, 3 imbalances, 156 against 37, 33 against 3, 95 against 7. Okay, now point B, again, we just turn around, go sideways. Here we have what's called a prominent point of control, right? Remember, every bar has a point of control, but there's going to be some points of control which matter, right? And that's what the software analyzes for you. It's going to tell you that, hey, you know what? This point of control is bearish, right? So you put it together with the multiple selling imbalances here. Obviously, you got the negative deltas as well. And the market sells off, right? It sells off from 65 down to 60, where you got a bullish prominent point of control. Okay, but if you're waiting for confirmation, oh, I want to break the bottom of this bar here. Well, you just gave up, a point and a half, 6 ticks of potential profit by getting in here later, right? You say, well, maybe we'll draw a trend line here. You're still not getting in any better even if you draw a trend line up from this bottom to this bottom. You're still getting short around, the 64 area. The areas you should be getting short in is, 65 and above. And again, let the software do the hard work for you, right? You could look at an order flow chart, a volume footprint chart, and see, yeah, I got some 3 selling imbalances in here. Maybe you can try and figure out, the concept of a prominent point of control and say, yeah, this point of control matters. Um, but why not just let the software do it for you? Make your life easy, right? On the order flow trader, the software, we have the setting right here. Multiple imbalances occur when there are 3 or more buying or selling imbalances in a bar. It's going to draw this violet box around it. Tells you that their aggressive buyers are clearly in control right now, or aggressive sellers are in control. Now, POC trader is what's going to tell you about prominent points of control. Again, it's hard coded right in there, right? You could adjust the settings, you could change the colors, whatever you like. Remember, every bar has a point of control, but not every bar has a point of control that matters. Prominent point of control is a point of control that's going to act as support or resistance. If it's a bullish prominent point of control, it's going to tell you that's support. If it's bearish prominent point of control, that's resistance. Let the software do that work for you, right? This is the normal candlestick chart. You can't see market imbalances, right? You can't see where prominent points of control acting as support or resistance are coming in. But if you're looking at a volume footprint chart, you can get software that helps you do that analysis. So you can see, yeah, I've got aggressive sellers here in this bar. I've got resistance in this bar. You're at a swing high. You've got aggressive sellers coming in. You got signs of resistance. Where do you think the market's going to go? It's not going to go higher. Chances are it's going to go lower, right? And the beauty is, that what you're seeing here, right, with the resistance, with the aggressive sellers, it's going to allow you to keep your stop relatively close, just above the high of this level, right? So you could be getting short here rather than later down here, right? You're going to find yourself with much better entries. Better entries equal better profits. Now, the other beauty of order flow is it's going to show you areas where the market is coming into where support or resistance is present, right? Don't end up like this guy, right? There's no support present. You want to be like the guy that can hold the weight, right? And think of the market the same way. You have supply, which is selling pressure. You have demand, which is buying pressure. Sometimes it's just too much. It's going to overwhelm the market. What you want to do is you want to find those areas where there's that support is present, where you can see it coming in. And again, yesterday, so just before around 11 o'clock, we came down into this low down here at 53. And then we started rallying up a bit into the low 60s. And then we're holding this area around 55 and a half, right in here, right? We keep coming down, test it, rally up, come down, rally up, come down. Then we start rallying up, and then obviously we rally all the way up from the 60 area into another 5-6 handles. Okay, but what's so special about this area? Anything? Well, people say, well, you got a low here, blah blah blah, etc. Well, why not think of, look at the order flow. Now, the POC is the clue, but honestly, right now, it's not so clear, okay? Because, yeah, you've got a bullish prominent point of control here. You got another low point of control here. You got a couple sort of around the same level. But did you know you could actually see up to 3 points of control levels in a bar. So you're not just going to know the point of control level with the most volume, but you can also know where the level with the second most volume and the third most volume. Oftentimes it's spread out, it's distributed among a bar. But when you start seeing groups of bars where they're all sort of clustered together here, 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 you know there's support in the market, you know. And people that use a heat map, right? A book, whether it's Bookmap or NinjaTrader's heat map or Jigsaw's, I think there's called heat map also. You would see like these orders filling in down here, bright orange colors, etc., to act, oh yeah, it's support there. But if you're just watching the order flow, you see, well, yeah, it actually traded decent volume here. It held 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 decent volume here. It held, and this is all around that 55 and a half to 56 and a quarter area. So you know that there's some very strong support here. And as the market finally popped up, where would think about it? If you know there's support coming in here, right? You buy in here, 57, 58. You have a stop just below this area in here, 55, 55 and a half. So you've got a very tight stop, right? You're getting long around, 57, 58 with a stop around 55 and a half. So you can see clearly where there is strong support or resistance at a level. And again, the beauty is let the software do it for you, right? You can see here on the order flows trader software, you could set up to 3 points of controls, right? The main point of control number 2, point of control number 3. Now you could even, I have, in this case, I have 2 and 3 set to transparent, but I'd set it to gray if I want to see the other two. Or you could get even more creative with the colors. You could have, you could set it to, in this case, I put it to green for the strongest, yellow for the second, red for the third. Okay. I'm not gonna get into it, but there's a reason for that. Think of red, yellow, green, right? Traffic lights, red, yellow, green, boom, look for the market to rally. Um, red, yellow, green. Yeah, a lot with order flow is pattern recognition. Now, what makes order flow analysis so extremely powerful and useful is that it shows you areas where the market can back up to and hold before continuing on in its original direction for another 10, 15 ticks or more. Order flow shows you those levels. Okay, here's another example. Yesterday, this is around 2 in the afternoon, quarter after 2. 2:15 Chicago time, market's just going sideways, right? If you remember that, right? We're just sort of trading, between 65 and 58, right? Just, it's just sort of snaking, going sideways. People can say, well, we got, got swing low, then your high, then higher low. Other people say, well, we got the low, we got the lower high, etc. So it could go either way at this point, all right? But honestly, looking at an order flow chart, yeah, it's kind of mixed, right? You have bullish signs and you have bearish signs, okay? That's where adding the second or third point of control is going to help you, right? When you analyze the second and third point of control, it really stands out what you're seeing in the market. And what you're looking for are sort of these clusters, right? Three bars or more with point of controls sort of grouped around the same area, right? So think about it. Here you have 3 bars, right? 3 bars. Each bar has 3 points of control, the most, second most, and the third most levels. So that's 9 levels over 3 bars, right? PLC 1, PLC 2, PLC 3. If you're looking at basically a price area zone, so to speak, where you have 7 out of 9 points of controls lined up, that's important information, okay? So you have it right here, right? These 3 bars. And then here, you've got also 7 out of 9. Here, you got 8 out of 9. So what do I see? I see this group of volume here, right? I see another lower group of volume coming in here. I see another group of volume coming in here. And what's that telling you is traders are happy to start trading, their size at lower levels, right? So it's migrating lower. The market is sort of migrating lower, where people are happy to start selling some more. Buyers are happy to start buying a little bit lower, try and buy lower. It's telling me there's a lot of supply. When you see points of controls migrating down, It's telling you supply is present in the market. And again, on a bar chart, you're not going to see that. And on this candlestick chart, right? You're not going to see this area in here. You're not going to see this area in here. You're not going to see this area in here. It just looks like this market is kind of mixed, kind of going sideways, nothing really. But look at the move that happened right after that, from 58 down into the 40s, right? And the beauty is, where you can be placing your stop, right above these little volume clusters, right? These groups of points of control, right? Stop. You put your stop there. If you're getting short after this group of point of control, your stop's just right here. If you're getting short off of the second box, your stop's just right up here. Off this third one, your stop's just right up here. You're trailing your stop right behind. And the beauty is, it's right before the market breaks, right before you start seeing all the aggressive selling coming in, right? Because what's happening? The value is slowly migrating lower. Now, if you're looking at a volume profile, say on the side, it's going to be hard to detect that, but you can manage it on a smaller scale right here, right before this market breaks down. You could have gotten the signs that, hey, you know what? We're starting to migrate lower in value. So, aspects of order flow analysis, such as point of control, delta, imbalances, are very useful for assessing market action, right? For identifying and evaluating trading opportunities. But, the most important part, of adding order flow to your trading arsenal is finding trades that the public misses, right? That's the whole power of order flow, right? That's how you get the most out of order flow. Now, I said earlier, I'm just going to show you charts on a 1 minute chart. I wanted to show you this on a 1 minute chart, but it was much clearer on a 5 minute chart. This is the E-minis from yesterday. Now, if you remember, right, the cash open, going into the cash open, we rallied up from this 66 area all the way up into the 80s, excuse me. And we put these two bars here, price action traders. Well, you got your two pin bars there, you got this double top, but why? Okay, it's nice to look after the fact and say, yeah, after this market sold off, and you say, well, yeah, you've got your two pin bars here, but if this market rallied up, it'd say, well, you had your two pin bars right here, right? So you should have bought. You had two pin bars essentially right here. The market didn't sell off, right? You could go through all of these things, and find a lot of patterns that didn't work, right? But what makes this level so special? Why did it come back here? Why didn't it come back up here, test this earlier high up here, or this high over here? Why this level? Why in here? Okay, people say, well, you have this resistance that became support. You can pull out all sorts of things out of your mind that, well after the fact. But if you're looking at the order flow, all right, this is what it looked like here, right? Those two bars on the order flow. This is the 830 bar and 835 bar, right after the cash open. Came right up here between 80 and a quarter and 81 and 3/4, then stopped and dropped like a rock, 50 points. Well, you go back, whoops, wrong chart. You have this cluster right here. Look at this. You got 1, 2, 3, 4, 5, 6 bars where the points of controls are essentially the same level. You got one up here, you got one below it, but you got 6 bars. You got 3, 6, 12, 15, 16, 17, 18, 19 out of, how many potential bars? All these points of controls, 12, 13, 14, 15, 16 out of potential 18 points of control, all at that same level. And this is a period over from 610 to 635. It's, essentially 30 minutes where you're putting in a lot of value here, right? So it's not strange to see the market come back right up to that level, right? Came right up here, came right to this level, right? Didn't come up to this level up here, didn't come up to this level or any other level. It came right to this level because this little group of bars, it showed strong resistance with the POC clustered together. And again, If you're looking at this bar chart, you're not going to know. You just go, oh, this little sideways action, nothing special. But in the order flow, right, you can see, excuse me, that's where the volume was. People say, well, you got these low volume bars. Well, at this time of the day, it's average volume. Why isn't the market going any higher? Every time it tries to go higher, sellers coming in. So buyers are back and forth, right? It's a two-way struggle in the market, right? Between buyers and sellers. Everyone is happy to transact at this level right in here. That's why the market came back to this level, not this upper level, not a lower level. Came back here because it was met with that same resistance that was here earlier, right? Remember, this market had been going up, came off a little bit. If it could have gone back up, but why not, right? There was sellers in here. So when the market got back up to this level, it was met with sellers again. And then the market dropped, 30 points from that area right after the cash opened. So, hopefully by now you can see how order flow analysis provides the trader, the kind of advanced information that they need to gain the edge over other traders, right? That's what you want, right? You want an edge over the people you're trading against. And how you get an edge is you find things in the market that other traders aren't seeing. That's where order flow comes in because it allows you to see what's happening underneath the market. People say see inside the bar. I like to think of it as, it's like when you pull up a rock, right? You got a rock sitting out in the yard, you pull it up and then you see a lot of bugs and worms underneath. That's what the order flow is, right? Telling you about this whole ecosystem happening underneath the bar that you see right in front of you. So hopefully you can see how powerful order flow analysis is. There's no need to overcomplicate trading. Trade what's happening right in front of you, right? So if you found this helpful, you'll really like the Order Flows Trader software package that I have, which makes order flow analysis easy. So let me ask, who wants to make order flow analysis part of their trading? Now there's two ways, right? You could do this on your own. You could spend a year, 2 years looking at a screen trying to figure out order flow. I know people that have spent years, literally, um, since the mid to 2013, 2014, looking at order flow, even to this day, still haven't really figured it out. And more importantly, you can waste a lot of money, right? By putting it in trading accounts, think you figured it out, and then after a few days, realize, after you lost 25%, 30% of your account, realize you don't know what the fuck you're doing. Then don't go that route, right? Take the easy route. Get the education and software that's made by a trader who has used order flow at the highest level for decades, right? I said I've been trading on an institutional level, right? I don't tell you about my background to brag or not. I want you to know where I'm coming from, where I learned this, all this, how to put these pieces together, and more importantly, you want to skip the wasted time, skip the trading losses. You get the order flows trader software. It runs on NinjaTrader 8. It's not available for TOS. It's not available for Trade of 8. It's not available for TradeStation. It runs on NinjaTrader. And yes, it will run on the free version of NinjaTrader. And it's the volume footprint chart with 7 pre-programmed order flow indicators. Later this summer, we're going to do another release. We've got another, I've got at least 4 other indicators that we're putting into the order flows trader software. So you can also, more importantly, you're going to get my chart template, and we'll show you if you have trouble installing the chart template. I'm going to show you. I even got a quick video to show you how to create your own chart template. And it bothers me, because I used to use different order flow software years ago before I came out with my own, and it was so frustrating because it was so darn complicated, right? And trying to there were, I'm a pretty resourceful person, and I can sort of figure things out, but I need, some direction. Where do I go? How do I change this chart to look like this? Because you'd see these guys with their software, a nice, beautiful chart. I can never get my chart to look like that. So you get my chart template so your chart can look just like mine, and you can modify it from there. Normally, I offer this for $8.99, right? But you're not going to pay anywhere near that today. But I realize having order flow software is one thing, right? The next thing is you have to know how to use it. I don't just give you the software and send you on your own way. I provide a lot of education on how to trade with order flow. I have a course, right? The order flow trading course. It's 15 hours of video instruction. When I created this course, I wanted something that could be done on a Saturday afternoon. But when I started recording, I realized it's probably going to be a weekend course, not a one-day course. Okay, but this really takes you through the basics of order flow, right? But I realize, most people at this stage really have a firm understanding of the basics of order flow, so they want something more advanced. So I give you access to my order flow inner circle video series. There's 56 videos on advanced order flows, tricks, tips, and analysis. Normally I sell access to this course for just about $500. I'm going to throw it in as well with the software. So, software, order flow trading course, the inner circle, normally it costs $1,693, 1,693. But again, I don't want you to pay that much. We're in a time of, a lot of people don't know, if they're going to have a job in 6 months or anything like that. So I'm going to throw it, we're spending at home a lot of time. I'm going to give you my favorite course that I created, my order flow playbook, which normally I sell for $297. Again, I'm going to give it to you for free. So you got a lot of educational material, right? Because I don't want you to fail. I don't want you to get involved in order flow and then give it up in a week or two. No, I want you to understand what you're seeing in the market. That's why I give a lot of educational material, because you got to know what you're looking at, and you're not going to know unless somebody takes you by the hand and shows you. Now, what other people are saying, Sheila says, your order flows trader software is remarkably helpful. I can clearly see now what's happening in the market. Like, for example, who's in control of the market on a very specific time and who's getting weaker as well. And other comments, from social media. If you really want to trade properly and understand what on earth is happening in the market, order flow is the path forward. And Mike's experience and explanations make it click. So you got to realize, right? If you want to be a successful trader, you got to go out there and get it. It's just not going to fall in your lap. It's not going to just one day automatically click in your head. You're going to understand I should buy here and sell here. No, right? You got to get trained. So, if you're interested, it's a one-time payment, $675. There's no monthly payments, no other payments in the future. You do need to pay your data fees and NinjaTrader fees. That's just part of trading. But the software that I have runs on NinjaTrader. You could run on the free version as well as the paid version, and it's just a one-time payment of $675. So what you do is you go to this page. It's down here at the bottom, orderflows.com/OF2 oft2.html. It takes you to this page. You see the link right up here, orderflows.com/oft2. Scroll down to the bottom of the page. There's some instructional videos there for you to watch. And you can see here, right, one-time payment, $675. What also you get access to? You just click that button. I want this. It takes you to PayPal. PayPal processes your payment. I don't get your credit card information. I don't want it. So if you stuck around and you want to get a copy of my book, go to this page, orderflows.com/book.html. There's a little area in here. You have to enter your name, first name, last name, and email, and click submit. After that, it will take you to a page with the book that's in the PDF form. You can just download it to your computer, print it, whatever. It's 150 pages. I want you to enjoy it. So, go. Part of life is about taking action, right? You have to get off your butt and actually do something. So again, go to orderflows.com/oft2.html, and it'll take you to that page, to get started. The most important thing I could tell you is you got to get started, right? You got to do something. Otherwise, it's going to be a year later from now. And you're going to say, oh my gosh, I should have got started last year. They always say, when's the best time to plant a tree? It's 20 years ago, and the second best time is yesterday, is right now. So, look at yourself. I know when this lockdown started, I'll say lockdown, this stay-at-home order in Illinois, because I live in Illinois. When that started, I had a big list of things I wanted to do. I've only gotten through maybe about a third of my list of things, but I realized, if I don't put this stuff down on things that I want to do now, while we're, I'll say stuck at home, but while we're at home, I'll probably never get around to doing it. So, and the same thing is about trading and learning to be a better trader. You got to start now, right? Now is the best time to start. VIX is coming down. VIX is, I think today is in the low 30s. If we get VIX down into, a more manageable 20, 15 to 25 area, I think the markets will be, really calm down. Markets are really starting to calm down now. So it's a great time to get involved in the markets. So anyway, Anna, I don't have time for questions, but I'm going to throw it back to you. Hopefully I answered everybody's question, and thanks for having me today.
Thanks again for having me. I'm Keith Harwood. I like to focus on swing trading when we've got market conditions like this. So that's what I wanted to talk about everybody with today, particularly with an options focus. As you can tell from Option Hotline, the company where I'm the chief options strategist. Before I go anywhere else, I want to start with our disclosures. My lawyers say I have to do it every time, so I do it every time. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Hopefully you all can take a moment here to read through this, and then we will get into the actual content and start thinking about how I can use options to get some real good leverage in the current market conditions. I'll give you guys just a few more seconds and then we'll get moving forward. All righty. Hopefully that was long enough. It's me. So for those of you that are not familiar with me, I'm Keith Harwood. I started in the options pits of the CBOE back in 2005. So before the subprime crisis, before the last really crazy market circumstances. Obviously, those were driven by financial companies, the subprime mortgage situation, and a lot of financial instrument leverage. The current environment, of course, is being driven by something completely different, a fundamental pandemic that's just been absolutely crazy to watch the way that it's going. So we'll talk about that in a minute, but first, let me wrap up kind of who I am. So after I traded through the subprime crisis there on the floor as a market maker, I moved off floor because markets started to tighten up. So what you'll often find is that market makers love it when the markets are wide, like they were a couple of months ago. Excuse me. When we had markets at lows, the width of those markets is crazy. And part of the reason that they get so wide is because there's so much more uncertainty. Uncertainty creates difficulty with knowing true value of options. And that means that the market maker needs to have a wider market, wider bid-ask spread in order to get compensated for the risk that he's basically taking. And as markets tighten up, that compensation is pretty minimal. The volume moves back towards those high frequency traders and the citadels and all these other market making firms that are much more focused on just getting as much volume as they can. So realizing and seeing that shift, I had to choose between basically learning more about how to be high frequency or find another edge in the market to pair with my options knowledge. And that's why I started focusing on technicals. So after I finished my MBA with honors from the University of Chicago, I went and joined a CTA. So a CTA is a commodities-based hedge fund. Traditionally, CTAs are very focused on technical trading. I figured if I can go to combine technical trading with options analysis, I can really get a good leverage. Options analysis on its own, very nice, very potentially profitable strategy. But having two edges on the market, having two opinions, an opinion on the direction of a stock and an opinion on the volatility of a stock, can create that much more of an explosive return profile. So I spent my time with them working on structuring options trades for them while they taught me more about the technicals and also the fundamentals of all these commodities, sugar, wheat, corn, oil, gold, all of these things. We worked on all the technical elements and all the fundamental elements and learned all the little nuances. And then I said, okay, enough of working with hedge funds and market making firms. Now is a good time for me to give back, go off on my own and help instruct retail traders on how I trade to hopefully help retail traders trade smarter. And that's the end goal right now, is just to try to help people understand, the nuanced stuff that we do on Wall Street, so that and the CBOE floor and everything else, to improve the leverage of your trades. If you have to leave early, really hope you guys don't, but I know some people do. Here's my contact info, so write it down now, keith@optionhotline.com. There's my phone number if you need to call me. I know that sometimes we run out of time on questions. I love it if you guys email me questions. I can follow up on anything there. We're also going to send an email out afterwards with some with a free giveaway and some other offers. Webinars@optionhotline.com should be the source of that email. So keep an eye out for that after the presentation as well. So today, let's get down to the nitty-gritty of today and what today is bringing the market. Today and every day, it's all about COVID. It's all about coronavirus. It's all about what's changing there. Today there was an update from Moderna that said that they are going to FDA phase 2 on their vaccine trials, and that was really bullish for the market, because now people are starting to see a potential light at the end of the tunnel. When there is no light, there is nothing but depression. There's nothing but darkness. People just get down in the dumps, and so does the stock market. Right now, I think people are starting to see that potential light at the end of the tunnel between Moderna, Gilead, and many others that are showing positive potential to get us out of this situation and start getting the economy flowing again. Speaking of which, we're starting to get the economy flowing in some states. Those are going to be a good test, I think, for the states that are being a little more conservative with it. We know New York is going to be more conservative because they got hit the hardest, and that's a very unfortunate situation. Illinois is kind of moving a little slower here, and I'm here in Chicago, and we're starting to see some signs of economic activity, but it's not to the level of, say, Indiana, our next door neighbor, who's moving a little faster. So we're going to see how all of these other states, the Indianas, the Georgias, the Floridas, change, and how the data starts to come out as they give people back their freedoms, basically, to go and do whatever they want. And hopefully we don't see a major second wave of the virus. Now, with that all in my background, that all in my backdrop, the swing trade is what I go with, because a swing trade is all about short-term price action. People that are looking for investment opportunities, you can get in right now and invest, knowing that probably 10 years from now, the stock market will be higher, because generally over 10-year periods, the stock market does tend to go higher. But for now, I'm looking for opportunities to capitalize on bigger moves in very short times, because if we can get these moves that are like 6% in a day, then I don't necessarily need to look for 10% in a year. So if I can figure out ways to capitalize on those 6% moves a few times a year or a few times a month, I'm going to do a lot better than I would just saying I'm going to invest and hold and never look at my account again. All right, so we're going to talk about triangles. That's the big formation I want to do today, and then we'll get through all the other stuff, the price targets I use, and the options analysis with it. Let's start with the coronavirus. Let's just kind of do our update. Here's the Johns Hopkins data. So the one thing I kind of want to point out with the Johns Hopkins data is I'm about to show you guys the CDC data. Johns Hopkins data says 71,000 deaths in the United States. The CDC says 44,000. This isn't to point out that one is right and the other's wrong. What it really tells me is that we don't know a lot of this information, okay? So we don't know anything, it feels like. We know that this disease is bad, but we don't have accurate data when, I can change between the CDC and Johns Hopkins and get such drastically different numbers, especially when Johns Hopkins says that their data source is the CDC. This is just a really tough time because, all the data that comes in, everybody's trying to do their best to figure it out, but we don't know for sure. What I do think we are starting to know for sure is this: the daily cases for the entire world seem to be plateauing. Now, that doesn't mean they're going down. That's the unfortunate element, but at least we're not seeing continued spiking and continued worse situations, I guess. And what I'm really starting to think through when I see that is that, okay, so some of our decisions, some of our political choices have led to, sorry, hold on a second, have led to a slowing of the acceleration here. There was a question just asked to see the CDC slide again. So if I go to the CDC slide right here, yeah, so I mean, you can see here that they've got 44,000 total deaths over the course of the last 3 months. Obviously, we saw that big spike in April and really falling off in May versus the numbers that we saw from Johns Hopkins. So, yeah, so let me keep moving through here to just a focus on the United States. The United States, they've just started kind of creating this chart, and you can sort of see the hot spots of where there's really big activity, and a lot of it's in New York, unfortunately. But again, we seem to have plateaued. We're starting to reduce the number of cases. This is giving optimism to people and to the market. The whole end point of this to me is, can we create market optimism, or are we going to have market pessimism? When this is happening, it's hard to be optimistic. It's hard to be bullish because every day it looks worse. When this is happening, it starts to look better. And I think people, again, are looking for that light at the end of the tunnel between a potential for a vaccine and for everything else that we've got potentially going on here. All right, let's get into now the fact that we've got the fundamental background, and I don't really trade fundamentals. I trade technicals. So let's look at some charts. Here's the S&P 500. For those of you that are not big on charts, what I'll do is I'll just kind of walk you through what I look at in the S&P 500 here. February, we hit our peak. By February 24th, it started to look nasty. By the end of March, we were basically showing signs that we had finished bottoming out the market here and started to recover. So where do we go from here? That's what I want to get at, or what I want to get into. This formation, where are we going from it? And I want to look at each sector. So we start with the big S&P 500. Now let's go to tech. Tech has done better. You can see tech is closer to the all-time highs than the S&P. So you see where the S&P is, still well below a lot of these moving averages. So I'll just outline the moving averages here just as a reminder. We've got a 10-day in purple, a 20-day in green, a 50-day in blue, a 100-day in yellow, and a 200-day in red there. So if we're kind of in the chunk of those for the S&P, but we're above all of our moving averages in the tech sector. And then the Russell 2000, the dog here, has struggled to recover, well below all those highs, and you can see still well below a lot of moving averages as well. All right, with all of this in mind, what's my trade? How do I take these charts and turn it into a trade? Well, I swing trade. So here's the definition from Investopedia. I think it's a nice little definition. Swing trading is a style of trading that attempts to capture gains in a stock over a period of a few days to several weeks. I'm dating these stocks. I'm not owning them forever. Okay. Take them out for a couple of dates, then move on to the next one. Warren Buffett, he is a big investor with a lot of capital. He has to marry the companies he's getting into. He's not going to sit there and put capital to work one day and then take it off the table the next. I can do that. You can do that. Most of us can. We're not playing with billions of dollars. So given all of this, the setup I'm looking for right now is a triangle. So a triangle takes the current market, and what I'm looking for is a stock or a market that has a lot of resistance above, but slowly the buyers are getting more aggressive. So what you'd see here is that every time we dip, the dip gets a little shallower. Now that creates an inflection point. When you see something like this, a coil occurring, it creates a spring load effect. It can create really explosive movement. So I want to get as close to that point here of the triangle. And then what I want to see happen is that one seller, let's just come up with a number here, $290 in the S&Ps and SPY. We get through that level that we haven't been able to get through. And when we do, I don't know where the next seller is. I don't know where the next seller in the market is unless I look back a little left in the market, which we can do and we will do. But if I get to a new all-time high in the process, it becomes even more crazy because who knows where your next seller is. We knew there was one here at the high. We don't know who's next. It could be 30 cents higher in the S&Ps. It could be $30 higher in SPY. And so that's what creates this explosive coiling effect. What we know is that there was a buyer getting more and more aggressive and a seller that is exhausted. If there's fewer sellers than buyers, and if buyers are more aggressive, my new direction is higher. Gotta find that next seller that's going to stop the market from going any higher. So when I look at each of these charts, we'll start with the S&Ps. You can see the triangle forming here over the last month. The lower end has been rising, and we've kind of struggled to get above about $290. So if we get above it, the kind of natural target points for me would be to look back here in March where we had a little bit of a bounce and say maybe we can go to about $310, maybe $315. Ultimately, can we make new highs above 340? Potentially. Either way, from 290 to 315, we're pretty close to 10%. From 290 to 340, wow, now we're getting close to 20%. So we're getting huge potential moves here if we can break out of this coiling effect. So I'm looking for how and when and what my signal is that we are done coiling. The NASDAQ has done much better. So when I looked at the S&P, we had that target from early March. NASDAQ's already gotten through that. Said, yeah, early March, that's nothing. Let's just shoot for the new all-time highs here, right around 238, 240 bucks in that range, from a current level around 220. That's pretty good potential as well. Of course, that's a little bit lower percentage. Tech has led the way for a number of reasons. Tech companies can often operate with people staying at home. Netflix does pretty darn well when everybody's staying at home. Roku, a lot of devices like that are being utilized by people staying at home versus something like retail. Really hard to go into Nordstrom's and shop around because Nordstrom's is closed. So you can do online ordering, and people are buying, their Lululemon relaxation clothes, but we're not talking about nearly the same effectiveness as I think we get out of a lot of the tech companies. Now, speaking of that retail and financials and oil, that's where we get back to the small caps, and they've struggled to keep up with this market move because a lot of them have just had to effectively shut down. So you can see that here we don't have the triangle. We've had a little bit more of an angle to it. It's a little bit more of what I call a wedge. I think this has got some explosive potential, but this really isn't the setup I'm focused on right now because it's not nearly as clean. We're coming to a point in the NASDAQ. We're coming to a point in the S&P 500. We just more have a channel here in small caps. So while I think small caps do have some potential to catch up, this would not be the kind of chart that I'd be looking at for this particular setup because we're not reaching the point in the coil. We're still kind of in the middle of it. And that can just take a little longer to get to a point. Maybe a couple of weeks from now, this becomes more explosive. But today, nah, let's focus on the ones that are a little easier to see. So now that we've seen it, where's support if this doesn't work? Well, when I look at the NASDAQ, you could say maybe support's down here at a moving average. Maybe it's all the way at the lows. That doesn't really give me a good defined risk profile. If I have to wait for the stock to go all the way back down to 165 from 220, I'm really risking way too much. So I have to figure out a better way to create a stop loss than to simply look at prior support levels, okay? Because we don't have that clean support. We had clean resistance. We knew where that buyer or that seller was. We don't really know where the next buyer is if he exhausts the seller and then he's done. Could be back down at this low, could be at this low, could be even lower. So I use statistical analysis to find my support levels. I also try to use statistical analysis to find my resistance levels. So again, we don't know where the next seller is unless there's a little bit there. back on the chart, and we outlined those today a little bit. If we get above some of those levels, now we don't know where resistance is. So we use standard deviations. Standard deviations are really important to me because this is how options are priced anyway. So options have a component called the implied volatility. Many of you know that. We'll get into that a little bit later as well. But what that's telling you is how big of a move you can expect every day, week, month, or year. If implied volatility is 16%, it means that the market thinks this stock is going to potentially move 16% over the course of a year. And it means that that stock is going to potentially move 1% every day. If I have a stock where the standard deviations, let's say we'll do the 1% number here. One standard deviation move is 1%, a 2 standard deviation move is 2%. So if a stock moves more than 2 standard deviations over my time frame, it shouldn't happen all that often. In fact, 2 standard deviations to the upside is about 2.2%. 2 standard deviations or more to the downside is about 2.2%. We're talking about basically once a month, if I was doing it on a daily basis, that the stock should move that much. So if I have a stock that moves down by 2 standard deviations after I was buying the breakout, that's a problem for me. It tells me that this was just a very much wrong trade. Down 1 standard deviation, I might need to be looking at reducing or exiting my trade. On the upside, because I'm finding a coil with leverage, I'm targeting this. I'm looking for at least 1 standard deviation, but more likely, I want that 2 standard deviation move. I want that outlier move, because that's how I can get really good leverage and get paid. Okay, with options, it's all about finding leverage. Oops, wrong button there. All right, let's go to the next slide here. The other thing that I want to point out here is that the market skew is not that normal distribution. We don't have an equal probability of up and down at the same magnitude. Generally speaking, this is our market, negatively skewed. We expect that if the market goes bad, it's going to go down a lot faster than it goes up. This actually creates a great opportunity for me when I'm doing a swing trade to the upside, because the market prices in this skew. It takes the probability of an up move and says, most likely we're going to go up a little bit. We're probably not going up a lot. If we go down, it's harder to find a floor. That fits with that triangle anyway, except for the fact that I don't think when we're breaking out of a triangle that we're only going up a little bit. I think there's a chance we go up a lot. I don't know the floor. That might be true, but I don't think the normal market skew implied by the options market and that goes daily actually applies here. So we have more of this kind of market, and we of course saw the fat tail to the downside over the last couple months and got really well reminded that downside is where people panic. All right, so again, this is how I do my stop losses. I do those standard deviations. I kind of mentioned this before, but I think it's important to remind ourselves here. 1 standard deviation to the downside, that's a bad move for me. 2 standard deviations to the upside, really good move for me. 3 standard deviations to the upside in a day, great move, because that shouldn't happen more often than about once a year. Now, I want to also remind you guys, the tails are fatter than the normal distribution, both up and down. We get 3, 4, 5 standard deviation moves all the time in individual names. Why? Because individual names come out with a little bit of news that moves them. Earnings often cause multiple standard deviation moves that are supposed to happen once every decade, and it happens every day. So I think that one thing we have to always keep in mind is that while standard deviations are our calculation, they're not actually as accurate as we want them to be. It's a function of the model. It is what it is. That's what creates more leverage for me. Because if we followed a true normal standard deviation, then there would be no point in putting a value to 3 standard deviation moves. And yet there's a small value to them, and I think potentially sometimes a big value to them. So that's our standard deviations. 1 down, 34% of the time we should stay within that band of 1 down to 1 up, should be about 2 out of every 3 days. If we get down below that, it's telling me that maybe my trade's wrong. To the upside, we had that rare occurrence. All right, so now that we've got the statistical analysis along with the technical formation, we got to go to the options. And I always like to remind people that options have risks because options are not as safe as a lot of people want to think they are. A lot of people think about the profit potential of an option, never really think about the risk profile of one as well. If you buy options, you can lose your entire premium because they all have an expiration date. We do not want to do that, obviously. So we'll talk about some of those specific risks as we go through an example. Transaction costs are often higher with options, though. There's that risk of assignment. Fortunately, the strategy I'm talking about here today, no risk on assignment because I'm only buying options, nothing sold. So if you don't sell an option, you don't have the assignment risk. The owner of the option has all of the decision-making power. Options decay every day. So when we're coiling, if I'm long options and the stock's not moving, I'm losing money. That's why I wait for that inflection point, because if I'm going to get into a name, I need the stock to move. Otherwise, I'm losing money. Volatility, value options is partially dictated by implied volatility, and right now, incredibly dictated by implied volatility. Implied volatility moves are insane right now. You can have an option cut in value by half just off of a move in the implied volatility, even if the stock didn't move against you. So for me, one of the big things that I always do is I always analyze implied volatility, and that's still the key here. There are other risks. These are the ones that you guys really want to make sure that you understand before you ever do an options trade. So now let's just compare the payouts and why I like options. If I have a $100 stock and I think it's going to $120 in the next month, and my stop loss is at $90, so we've got, one standard deviation down is $10, 2 standard deviations to the upside is 20. I've got a nice little risk reward profile if I'm right. If I have $1,000 I'm willing to risk, I can buy 100 shares of stock, which will cost me $10,000. And as long as I can exit at my stop loss, I'm okay. Here's the problem. Sometimes stocks gap through stop losses. What if it turns out this company is just a fraud? I could wake up tomorrow morning and it's trading $50. So while I might think that I'm only risking $1,000, in reality, I'm risking every penny I've put into this stock. Always important to remember that because stop losses can't always be executed because the market can gap. With a call, I can make the same dollar risk investment of $1,000 and get more leverage. So a reminder on a call. A call gives you the right, but not the obligation to buy a stock at that price, the strike price, at any time between now and expiration. Okay, so if I'm long the $100 call and the stock's trading $102, I get to buy it for $100 still. If I'm long a $100 call and the stock's trading 90, I can just say, you know what? I'd rather not buy it for $100 because that's $10 over the current price. So if I have these calls, and in this scenario, I just created a call that's a $5 call at the money, expiring in a month. For $5, I can control 100 shares of stock. So $500 is the total investment. You got to multiply it by the number of shares you're representing. So if I want to risk $1,000, I can buy 2 of these calls. Represents 200 shares, gives me $1,000 of risk. And if the stock goes higher, I make more money because of leverage. I've also defined my risk. So if the stock does wake up at $50, I'm not out any more than I invested. The options perform better on bigger moves. So below $90, I was better off being in options because of the defined risk elements there. Above $110, I was better off in options because I got leverage. That's my goal. The trade-off is, of course, the window in between. And the stock here, in this case, those call options that cost $5, that means I have to get to 105 before I even break even. So I better think this is going to move. Again, during the coil, I'm not buying options. Getting out of the coil, that's when I'm buying options. Now, another big key here, if you take away nothing else, this is the one that I always try to remind people because I've seen it happen so many times where people do just terrible job of risk management. And I hope you guys can all avoid that major mistake. If I'm willing to spend $10,000 on a stock, why wouldn't I buy 20 calls and have that huge leverage? I could make $30,000 if the stock goes up to 120. That's awesome, except for the fact that if the stock doesn't move at all, I've liquidated my entire account. So I risk everything with only a 30-day window. That's not good risk management. You don't want to risk your entire account on something that will lose money. Frankly, a lot of the time, 50% of the time, the stock's going to stay where it is or go lower. Okay, 50% of the time you expect it to go up, 50% of the time you expect it to go down. So why would I put that? I mean, maybe with my technical analysis, I can get that skewed to being 60 or 65 or 70% of the time I'm right, but I'm still risking my entire account at least a third of the time, and that's not good. So always, always, always pick your sizing based upon your risk tolerance, not based upon the potential reward, and not based upon your just using the entire account. So again, the risks we talked about here, transaction costs are crucial because if you're looking at options, higher commissions and fees. Assignment, not an issue. Decay, huge issue. Volatility, incredible issue, especially in the current environment. The reason I focus on volatility is because that's my sale rack. I want the clearance rack when I go into a store. I can't go into a store right now. So, okay, online shopping, I'm looking for the clearance items. Here's the difference in the value of an option depending upon implied volatility. So I've got a little chart here for in the money options, at the money options, and out of the money options at various implied volatility levels. In this scenario, I basically just created a $5 valuation for that at the money call with a 36% implied volatility. So if that's fair value, then if I find implied volatility cheap at say 30%, and I'm buying these calls for $4.20, I'm getting them for 17% off. That's a pretty good sale. I got a good discount on that. Now, if they're priced high volatility, like we saw the last couple months, they could go up to $5.87 as an example here, and they're 16% overpriced. You see that ratio there? Basically, I want to try to find stocks when or options when they're on sale, not when they're trading at a premium. And further, I use out of the money options when implied volatility is cheap. Look at those $106 calls. Okay, if I'm buying them for $2.70, I'm getting fair value. If I think they're worth $2.70 and I can get them for $2, this is a great deal, right? I can buy 5 of those calls for $10 instead of only getting 3.5 of them for $10 at fair vol, or 3 of them when it's expensive. So all that leverage kicks in when the options are cheap, not when they are expensive. The key is always, for me, cheap options with an explosive technical setup. The VIX right now is coming down. It's around 30. It could go back to 15. I don't think it's going to 15 until we have a lot more clarity on this COVID thing. Now, I'm not saying it can't go to, say, 25 or even 20, but 15 takes a lot of work. The market has a memory. We remember the VIX in the 80s. People aren't going to just sell options when the VIX gets to 20 without a really darn good reason to do so. So we have to see the market moves drop as well as clarity on the fundamentals, because uncertainty leads to more implied volatility. But here, we're starting to get some good discounts on individual stocks. Maybe not on the whole market, but individual stocks certainly have some good leveraged options. Let's go back to that, the chart before. I want to show you the risk reward and remind you again why I want discounts here. So here's when implied volatility is cheap. Here's when implied volatility is expensive. You can see that I get a much steeper slope here on $1,000 of risk in those out of the money options when implied volatility is cheap. It's just the nature of the game. Zoom in more. You can see here how much extra leverage I'm getting if I'm right on my move. Risking 1,000 to make 6,000 if I go with these out of the money calls. Of course, I need a bigger move just to get my break even. But if I think there's a potential for huge explosive moves, this is what I'm looking for. You know, 4, 5, 6 to 1 kind of return profiles are really attractive. When implied volatility is high, it's clearly a much lower payout. Those out of the money calls basically pay off almost as well as stock, but take a bunch of risk on the way. I don't want to buy options when they're expensive. That's why I do my analysis every day. Every time I look at a stock, I'm doing the same analysis. So here's my trade on these breakouts. Here, yeah, you just get it. So I'm looking for a setup with low implied volatility relative to its long-term norm. So we're talking about implied volatility being about as low as it gets. I have a number of tools I use to do the analysis on that. And then I'm just looking for something that's expiring in 3 to 4 weeks. Why? Because 3 to 4 weeks gives me a good balance of time and leverage. If I used an option that expired in a year, I don't get much leverage. If I use an option that expires in 2 days, I'm taking a lot of risk. If I don't get the move on day 1 or day 2, I lost my money. So I like to have a little bit of time just in case I was a little early. But 3 to 4 weeks gives that good balance. 30 delta options. So 30 delta options is going to be an out of the money call. That's that like $106 call that I was focusing on. That's how I do it with them. I'm looking for a move of 1+ standard deviation on the breakout's great. Really looking for 2 for that really big leveraged return, because if I get a 2 standard deviation move in an example like the one I just outlined, then 1 winning trade can pay for 5 or 6 losers. That's great. So if I can get a win rate of close to 50%, I'm hitting home runs, and I'm not that worried about the losses that I take for those names that do fail on the setup. That's it. So other stuff that I'm happy to discuss if people have questions about it, or if you have emails to follow up, skew, term structure, open interest, all these things are great. Again, here's my contact information, keith@optionhotline.com, 312-600-8004. Look for that offer on the webinar webinars@optionhotline.com. And I'm going to just give you guys the coupon code now to make this even easier on you. The way that I execute these ideas, I've created a service called Home Run Swing. So it's because we're looking to hit home runs. Go to optionhotline.com/home run. Now you're there. So normally it's annual is $19.97 a year, or monthly. That's the semi-annual. Let me go again. Monthly, there we go, is $197 a month. So you're already getting a good discount if you go to the annual. Today, hit add to cart, and then type in a coupon code. Oops, I've already got this in here twice. Let's get that back down to 1. Update the cart. The coupon code is amazing year. So you would type in here, amazing year, and hit apply coupon. It's already been applied here, but you can see here, 1997 drops down to $9.97, and every recurring year, you get that same discount. So you get $1,000 off per year, every year. So if you like this idea, you want to try to hit home runs, you want to use these swing trading opportunities, this is a great way for you to learn more about it. If you want to learn more about the product itself, just go back to optionhotline.com/home run. We're talking 15, 20 trades a month, all short-term swing trading. You get also my educational course about it, and a little bit more detail on how I find these swing trading setups. So with that, why don't I leave it to questions here? I'll put on chat here the link again. Oh, it's already there. Thank you, Anna, for putting that out there. All right, are there any other questions here? Looks like we've kind of exhausted everybody here. I'm hopeful that everybody's not too tired to get back into the market, but you never know how it's going to go. All right, for now then, let's do this. Put this back up. Yep, there it is. Again, there's my contact information. Question, do I teach spreads? Absolutely, I use spreads for some breakout setups and swing trading setups as well. The type of spreads I normally use are actually diagonals. So what I look to do is own a longer term option that's closer to the stock price, and then sell a further out of the money with a shorter time frame to it. There's a lot of nuanced reasons I do that with the way the term structure works in individual names. But yeah, that's my normal spread, and that creates a way to basically cheapen my trade. Oftentimes I'm doing that when I see clear resistance above the market. So I'm thinking to myself, if the S&P 325 calls are really expensive in the next couple of weeks, then I'm not that worried about being short those as long as I've got the leverage on my side still from being long something like a 310 call. Right now, 325 is too far out of the money to really make it a great sale, but you can kind of get the idea there and do that sort of almost like a buy right setup. Results for the past few weeks. I actually don't have those up right now. That's a good question. So I can tell you that for the year, we were up right around 30% right now on home run swing. Normally, I'm looking for 15 to 20 trades per month. In this current environment, when volatility was high, it was a lot fewer, frankly. I basically just waited for stuff to shake out. Now looking at a bunch of new opportunities again. I can tell you we got into Roku, and that was a home run. All the options are on individual equities for this. And the reason that we use individual equities on it is because that's where I get really good leverage, but also greater gap potential. Futures, just basically they have better liquidity and often gap less. Let's see, how far out are my long option positions on a calendar diagonal thing? Yeah, I'll usually look at long options a little bit further out, maybe 4 to 6 weeks. If I'm doing this still without the money options. And then the short option is usually 2 to 3 weeks before the long option. So if I'm in a 4-week option on the long side, I'm probably selling a 2-week out option. If I'm long a 6-week out option, I'm selling a 4-week out option, if that kind of makes sense. Yeah, I'm not doing long-term positions on these calendar diagonals. I have other services that do a little bit longer, but we're talking my long position being 3 to 4 months out, and that fits with more of a trend trade than a swing trade, though. Yeah, so this right now, everything we've talked about here fits with the home run swing service. This is all about leveraged, explosive opportunities, not the trend trading or the trend picking names that we've got other services on. And yeah, most of the trades are in weeklies because that's where we get great liquidity now. Again, we didn't get great liquidity, frankly, a month ago, but we're getting great liquidity again in the weeklies, and that allows me to really fine tune my entry. When all the options were based on monthlies, it's a little hard to do that because I don't have options always expiring in 4 weeks. But now that we have these weeklies, I always have an option that expires in 4 weeks, no matter when I'm looking at it. I think we're getting low on time here. We got about 1 more minute. So just in case you guys have more questions, again, feel free to email me, keith@optionhotline.com. Make sure you take advantage of that coupon code that we put there into the chat, and I'm looking forward to talking to more of you. We do have a monthly subscription as well. And the coupon code for the monthly, I'll type out here, is, where is it? Mighty Month. So I'll type it in here to all. There you go. So that would be your coupon code if you wanted to look at a monthly option. But you get a little bit more discount by going to an annual because of the, you get basically 2 months for free. All right, looks like we are up on the time. Again, feel free to email me. Looking forward to talking to a lot more of you soon.
cool. All right, so thank you, Anna. I could take it from here. I appreciate being here, everybody. I want to thank Michael and Keith for doing such an amazing job. I enjoyed both their presentations. I always learn so much sitting in on these. And I'm happy to be presenting these new ideas to you. I'm going to talk about this concept I came up with using a multi-trend indicator I created and a couple other indicators, one of which I'm going to give to you free at the end of the webinar. So hang out at the end of the presentation and I will make that available to you. I'm going to show you ways you can use it as well. I think you're going to really enjoy it. While I get started, if you guys wouldn't mind doing me a favor, could you just kind of type into the chat where you are from? I always love to see where everyone is tuning in from. We're a real small community, but we're also spread out all over the world. And as you can see, my logo down in the bottom right corner, the Backpack Trader, I mean, that's quite an image, isn't it? And it does not imply schlepping all over the world. You know, although some of you may like to do that. I know I sure did when I was younger. The whole point about the Backpack Trader is to be able to achieve a level of freedom for yourself, a level of personal freedom that you can get from trading. Now, is there anyone in here who doesn't want freedom? So I've got New Jersey, Chile, San Francisco. Welcome, San Francisco. That's where I'm from. Minnesota, Germany, Vegas, South Carolina, Chicago, Sweden, Florida, Michigan. Yeah, so welcome Singapore, South Africa, Canada. All right, so good. I'll keep naming some out if you type them in, but the whole point is that we're all over the world. And I've been to many of those places. In fact, I started trading in and out of the internet cafes as they were popping up all over Western Europe in the late 1990s and really was able to take advantage of the whole dot-com boom. And it wasn't because of skill, it was just from being lucky. I mean, anyone that could fog a mirror could place a trade and make money those days. But the thing that I learned from that the most was this element of freedom that I could achieve by trading, and that changed my life. Okay, so just to give you a little bit of some foundation before I get into this. Also, just like my colleague Keith, let's see, risk. Trading is risky, okay? So just realize that. And just like the guy that speaks really fast after every commercial with Rocket Mortgage and bank commercials, you know, they drive you nuts and you want to throw water balloons at them. We got to show this risk disclosure all the time. So it's just important you realize that. All right, so let's move on from that. So this is who I am. And if you want to visit my site, I'm developing it. It's actually pretty new, backpacktrader.com. I came from a company called NetPicks, or one of the oldest online trading education firms. They've been around for probably 25 years now. I was with them for the last 15 years. Back in 2018, I spun off my own business. After 15 years, it was finally my time to do it. I started with them, just like you, sitting in a presentation, just like this. They showed me something that I needed. At the time, I was doing pretty good as a trader, but I was missing stuff. And one of the main things I was missing was structure. It was a method, something that I could define, learn really easily, do it over and over again, get really good at it, and then just keep things super simple. And then finally, and this is something that I started to focus on over the last, the first few years being with them, you got to hang on to your money because it's so easy to make money in the markets. It's even easier to give the money back, especially as a day trader. So having a strategy that allows you to keep your money is critical, wouldn't you say? I mean, we're all here to make money. So let me ask you guys a question because this is going to set the tone for what I'm going to start showing you. Do you want to win every trade? Or do you want to make money? Because this is something most people don't think about. And most people will shake their head yes and go, well, I want to make money. And I realize there's losing trades. But then they go about trying to not, they try to win every trade. And they try to correct losing trades that probably was a good trade. It just happened to lose. And that's always a mistake. So if you focus on just trading to make money, then you can finally move forward and start making money, even if you have losing trades. So the big thing to take away, if you don't take away anything else from what I'm telling you, is that it's okay to lose trades. What you want to do is you want to quit your session positive a majority of the time with minimal and efficient trading. Now I'm speaking as a day trader, and the reason why is because I run a trade room, or I've been running a trade room for over 15 years. I started with NetPicks as a customer like you. They heard me talking to people in one of their forums. The owners liked what I said. One day they called me out of the blue. It was a shocking phone call. And they said, hey, we're growing our company. We think you'd make a great trade coach. Want to give it a try? We don't have one yet. You'd be the first. And I thought about it for a little while, and I said, okay, but I want to do a trade room. And then they thought about it for a little while, and they said, okay, we'll give you a shot. And so I started calling live trades. Now imagine being in front of charts in a live trade room every day for 15 years. That's a lot of chart time. Now imagine the very first day after never doing it ever, and now the curtains are going to open and there's 160 people waiting for you to show up and say hi and start calling trades. What do you think's going through my head at that moment? Well, this is the thing that changed my life, because I could have freaked out, stage fright. It was scarier than going on stage and singing a solo in front of a bunch of people. A lot of people think that, they'd rather walk the plank and jump in the ocean than go on stage and sing in front of a lot of people. Well, that's how I felt on the very first moment that I was going to start calling trades. And then a little voice went off inside of my head. 4 simple words changed my life. Lean on the system. That's it. Lean on the system. And I can't tell you how important that was, because ultimately it took the pressure off of myself. And what I want you guys to do when you're trading is not feel pressure. Right? You have to take the pressure off of yourself, and there are ways to do it. But most importantly for me, being a trade room moderator host at that very moment 15 years ago, not knowing what I know now, was that I realized as long as I lean on the system, if the trade wins, I'm a hero. And if the trade loses, I'm just doing my job like a professional, because I'm leaning on the system, and the system said, that's the trade. You see? So with that realization, it took all this pressure off of me. And as a result of that, well, I've got a lot of stories. I'm not going to sit here and tell you a bunch of stories. I'm not even a slides guy. That's why I've been hanging out on the slide for so long. I'm going to get right to the charts. But you're going to see the importance of those 4 simple words, lean on the system, as I go through and show you what I'm about to show you. All right, fair enough? So I like interaction. Feel free to ask questions. I'll do my best to get to them. So if you stick around, I'm going to give you a link, and I'm going to give you a link to something that I'm going to show you. It went into the creation of my newest strategy, the Catapult Trader. Over the years, I've created strategies that have been some of the best on the market. They've sold in over 110 countries, and I have thousands of users worldwide, dating back to my earliest 7 Summits Trader. It was often called the Mighty SST, which led to Trend Jumper, which led to Counterpunch Trader, Spotlight Power Trader, Spotlight Master Suite, Fun with Moving Averages, and now my newest, the Catapult Trader. And if you could imagine getting into a trade and having your profits catapulting as the trade catapults, they literally look like they've been flung out of a catapult. And there's nothing more exciting than that. And I'm going to show you. All right. So anyway, I don't care if you buy anything from me at the end. I just want you to have this indicator. I want you to be in touch with me. I'm not here to sell you anything. I don't need the money, but I like to build relationships. I've helped a lot of traders over the years. It's what I do. The traders that I've helped, they end up getting my stuff anyway because it works. But regardless, what's more important to me is to leave you with something of value. And so when you think of me next time, you're going, yeah, TJ's pretty cool. He's a backpack trader, and I learned something from him. All right, that's really my motivation for being here. All right, so let's move on. In fact, we're going to go straight to the charts. I just kind of stole my thunder and gave you a look at one of the Catapult trades here, but let's get rid of these slides. I'll come back to them at the end, and I'll give you a link where you can get a download, okay? So the first thing I want to do is look at yesterday's session. Normally when I do these presentations, I like to look at today's session. Just like a trade room, trading is real. It's at the right edge of the chart. Anyone could look in the past, but here's the thing. I just did this presentation yesterday and today hadn't happened yet. So I needed something to at least put together to show you, okay? So what I'm gonna show you is what I'm gonna be giving you. This is called the Catapult CCI. Now, you probably know what the CCI indicator is. It's a pretty darn useful oscillator. It can be used in a lot of different ways. I like to use it as an oversold, overbought indicator primarily, and then I'll show you a way you could use it as a confirming indicator. To me, the right, a winning trade method is like a great plate of food, right? If you follow a recipe, you know it's delicious every time, it's gonna taste great every time, and if you change the recipe, you know, buyer beware. It may not be as good until you get, you know, become a higher level cook. Then you can maybe add something and make it better. And the same with trading. So a good trading strategy has the right ingredients. And if you pollute it too much, you could ruin it. So I learned that obviously years ago. And my strategies tend to give you something that's really simple that you can learn. You could do it over and over again and get really good at it. And then it's just a matter of duplicating, rinse, repeat every day, do it the same way. And in the backpack trader style, you don't have to trade more to make more money. See, I'm a maverick in that regard, and I take a lot of flack from people who disagree with that. Fine, I stand my ground. I'm a big believer in trading less, using Einstein's eighth wonder of the world, the power of compounding. You give yourself a raise by moving your finger from the 1 to the 2, and then the 2 to the 3, right? You don't have to trade more if you have something that wins a lot. You just do it the same way over and over again. And as a trade room host, I learned that because I followed the exact same charts for years. Same chart, and you get really good at it. So that's the whole point. All right, so I like to combine 3 or 4 elements, and every now and then I might add a 5th. And I'm going to show you these elements in my latest strategy, but I'm starting with maybe the 2nd or 3rd element because I just want you to see something. Normally the CCI is a bunch of squiggly lines. I created a histogram out of it, and when it pokes down below a certain level, this red line, the bars will turn red, and that means that the market is oversold. So when you see oversold, you might be thinking, well, there's a good chance the market's going to go up. Notice that I'm keeping it super simple. I'm not looking at a bunch of stuff that's going to make my eyes go cross-eyed and have me thinking so much. And the markets are moving. I don't have time to think too much. I need to react. So I'm going to be looking for a place to maybe get long, right? So notice the market went up. Now that's not always going to happen, but oftentimes it does. Sometimes the market will be oversold and it'll just keep trending down, 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 down. But you have to look for clues. And so one clue is that if the market's oversold, you want to look for a chance to get long. Okay, so that's how I use this indicator. And we're going to look at some more examples. There's a couple other cool things in here that I'm going to show you also that we can add. In fact, I'll just show you really quickly. We could put some levels in here like so. And again, I'm giving this to you. So now it looks a lot different, right? So when you start putting the right confirmations in place, you can use the momentum indication that the CCI gives you when it's crossing over a line and moving up, 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 up as part of your confirmation process. All right, so I don't expect you to understand exactly what I'm saying yet. It's just a concept I want you to keep your eye on and be thinking of, and I'll show you examples in a moment. So the next thing that is like the heart of most of my strategies is an indicator that marks the power between buyers and sellers. Now, obviously, there are a million ways to do that. In fact, Michael came on earlier today and he was showing his way of doing it. It fascinated me. I may take this course because I'm so interested in it. But as a trader, I'm thinking, wait a minute, I want something simple for me. So especially with doing a trade room. So this is what I use. And these are my catapult lines, but I've used a similar thing in all my other strategies because I just can't seem to get away from it. Because what it does is it marks the balance of power between buyers and sellers. And if I know who's in charge, then that gives me valuable information. Notice now that the histogram and these lines, if you know what they're saying, already you're better off than 90% of the traders out there, just with these two things and nothing else. Even if you don't have the histogram and you only have these catapult lines. So the dotted line is a slower line, and we could even go slower. I mean, I've used slower ones than this for my other strategies, but this is what works with catapult. Notice that when the bars are closing below, then the market tends to go down, and when the bars are closing above, the market tends to go up, right? Well, when you put a faster one on, and you can use that as extra confirmation, now you got this pretty cool thing where green means up and red means down. Green means up, red means down. Pretty simple. But still, what happens when the market's sideways? You can get some wiggly, you can get some up and down, and you need to have certain ways to filter out some price action. Now, here's the thing. Remember what I said? Who's trying to win every trade, or who just wants to make money? This is critical, because if you're trying to win every trade, you're not going to make money. But if you're just trying to make money, you're going to make money, and you might have some losing trades in the process. So let's make money, because then you could become your own best version of the backpack trader. And whether you want to trade from your sofa or the Siberian Express or anywhere in between, you're in charge. You have the freedom and the power to call your own shots. That's what trading can give you. So this is really important, right? It's so darn important, because it can give you the lifestyle you've always wanted and always dreamed of for yourself. So to me, that's really, really important. It's the kind of lifestyle I like to live. I haven't had a job since the mid 80s. All right, that's the last time I had a real job. You know, that's the beauty of this, even though I wasn't doing this then. So, all right. I was going to talk to you about multi-trend, and I'm going to show you that in a moment. But what I want to show you is the key to the catapult strategy is the trade calculator. And the trade calculator does all the magic. It takes all the rules of the system, and it puts the structure on the chart and starts printing trades that you can follow. And now you're going to see some winning trades, you're going to see some losing trades, and I'm going to talk you through the trades and explain how it works. But the next ingredient that's not even on the chart, that's more important probably than anything else, anything I've shown you so far, is the concept of trade plan. If you don't have a trade plan that you can prove to yourself in advance, I'm a strong believer that your odds of success are greatly diminished. And if you want to be your own version of the backpack trader, you don't want to have diminished odds. You want to have enhanced odds of succeeding. So what I try to teach the traders I work with is how to create a trade plan that you can prove is going to make you money, where you can quit your session with a positive result a vast majority of the time with minimal and efficient trading, and then you just get really good at it. And you do it over and over again. And even if you only spend 5 minutes, like I have my best trading days, I literally spend a few minutes and that's it. I don't have to keep trading, because I know I'll do the same thing 6 months from now and I'll have many more contracts on there on the very same trade. And I make more money like that, you see? So I don't want to be exposed to the risks of the market if I don't have to. I'd rather be out doing the things I love to do in life. So I hope you guys feel the same way, but that's the whole point of the concept of the backpack trader. It gives you the freedom to just do what you want when you want. Question, do you have a video showing your use of the system live at the hard right edge? Yeah, I have videos. I have a YouTube channel. I'm gonna give you a way to contact me. And when you sign up, if you could sign up, I have a boot camp coming up. I'll tell you about that in a moment. All right, and we're gonna look at today's charts. We're gonna look at what happened today also. All right, because that's real. So I'm just using this to explain a few things to you, and then we're gonna look at like today. All right, you know, that's random. That's as random as could be. That's what trading is. So let me explain. Let me first say there are times to trade the E-minis, and I'm focusing on the Dow E-mini and the ES. Okay, I'm a big fan of the others too, but I'm a one-man band now since I left NetPicks, and I can only do so much. My other strategies are universal. You could use them to swing trade options, Forex, day trade. My strategies dance with the market, and they tune themselves bar after bar, trade after trade. So you'll notice that this trade down is larger, this trade up is smaller. Look how accurate the target is. Look how accurate that target. It'll barely miss a target 4 there. So let me quickly explain. The little plus sign, that's your entry. Remember, red is down, green is up. Now, I also have my Spotlight Power Trader, and I put some of that technology into this. And if I turn that on, let me just show you. When you get into the calculator, you got all these tools, and they're preset, but there are things you can do with them. And I teach you this. This is why I do boot camps. But for example, if we go to the graphic controls, I could turn on Spotlight technology here, and sticking with the green is up, red is down idea. Now look, the trade down is red, the trade up is green, flat is gray. The bright color goes in the direction of the trade, so bright red closing down, the dark red closing up, bright green going in the direction of the trade. All right, so the little plus sign is your entry. Our typical objective is the first target, but it oftentimes will be the second or the third or all of them. I'm showing you micro contracts, and I'm doing that for a reason, because then you literally can split your position up and scale out at different targets and even trail for the big catapult trade, which I haven't shown you yet. Okay, notice that when the market was oversold, we're looking for a place to get long. Green means up. It gave a long signal, and it came up and it hit a perfect target 3. So if you've got, a variety of micro contracts here, you could scale out a percentage of target 1, target 2, target 3, etc. So the stop is right above the setup bar, and it's looking to push down to get you into a break-even position as quickly as possible. You see how it does that? So usually it's when it's hitting its target 1, but we could set it anywhere we want. All right, and then it's going to trail, and it's going to trail a variety of things, which I'm going to show you also. So I don't have a lot of time, and I just wanted to, I usually will do this in a boot camp. I could talk about this for hours, so I want to quickly move forward. Let me just show you this. When you click on a setup bar, over here you have a data window, and it gives you the entire trade. So when I talk about structure on the chart, that's what this means. It's right there. There's no guesswork, and we're going to look at the right edge of the chart in a moment. Another thing I built into this is a position sizer. So if you open up the calculator, you can tell it what your account balance is and what percentage of it you want to risk on any given trade. I recommend 2% on a trade plan that you have proven to yourself first. Remember that we want to make money. We don't want to give our money back to the market. 2% may not seem like a lot, but imagine using Einstein's eighth wonder when you start using power of compounding, right? That's what keeps you in a safe place, and you could still grow your account. Now, you might go a little more than 2%, you might go a little less, and you could do that in the calculator. So let's just say we're starting with $20,000, and we click on this bar here. Notice in yellow, it's going to say, oh, okay, I could afford 10 micros. Now you're like, 10's not very many. Well, the reason why, it's a very large trade. It's risking 74 points. 74 points is pretty large. So it's going to take your capital, your risk, and what the risk is. Now notice this is a lot of valuable information here. You could see how much you're risking. You could see how much you can make at each target, and you could see risk rewards. Anything, even target 1 is almost 1-to-1. It's pretty darn good. But when you get to target 2, 3, and 4, you're better than 1-to-1. You see? So then the next trade is smaller, and how, you just, now you can put 15 contracts on, and you still got the beautiful risk reward ratios. So if you lose, it doesn't take much to recoup. See how that works? A question, this is a strategy. Does Catapult work on NT8? Please apply to FX. All right, so great questions. Catapult, because I'm one person, I'm deep diving into each market one by one. And so this is a modular strategy. So I have some Forex strategies are awesome, and I'm hoping to make a Catapult strategy for Forex through the summer. That's my plan. Through the summer, I'm going to be focused on Forex. All right, right now it's the ES and the YM. And then I have an NQ that's nearly ready as well. All right. It works on NinjaTrader 7, NinjaTrader 8, and TradeStation. And TradeStation will buy this for you. You could get this for free. TradeStation is going to give you commission rebates. You're going to trade, you're going to make commission, you're going to pay commission, and they're going to put 20% back of what you pay in commission into your account until the entire cost of anything I have is paid. Because TradeStation knows my members tend to succeed at a much higher rate than their normal customer base. And so I have a long running relationship with TradeStation. They want you as their customer if you're using my stuff. And they're going to buy you my stuff. They will pay for it for you. That's how much they believe in it. That's an endorsement that TradeStation gives me. All right, so just so you know that. It is a strategy, but the automation aspect is not yet developed, and that will come out as a more advanced package later, if that's what you're asking. Right now, it's indicators, rules to follow. You place bracket orders. I teach you how to place these trades, so it's semi-automated, but the automation package will be forthcoming. Okay, it's not on multi-chart. Sorry about that. NinjaTrader 7 and 8 and TradeStation. When I come out with Forex, I'll make one for MT4. Maybe I'll do something for some of the other platforms I haven't decided yet. Like, again, I'm one guy and I just want to do things really good. I'd rather do less and have it really good. That's part of the backpack trader philosophy as well. Let me show you what I'm super excited about. Okay, so I was going to show you a multi-trend thing too, which I'm going to, but the kind of charts that I'm trading right now are these custom Rankos. And the reason why is because these really show the catapult trade. All right, but before I even show you that, I promised to show you today's trades. We were just looking at, was that the YM? I think it was the YM. Yeah, YM. So let's look at the YM. So the trade plan starts at 9:30 Chicago time. Okay, everything's exchange time. Not 8:30 when the market opens, because between 8:30 to 9:30, I find that that's a time frame that's kind of flaky. Remember, I want to quit with a positive result a vast majority of the time with minimal and efficient trading. And the 9:30 start time allows me to do that using a very simple 5-minute chart. I'm not a big time-based chart. If you followed any of my work in the past, I always liked the dynamic charts, momentum bars, range bars, tick charts, charts that are dynamic to price action. A time-based chart only cares about time. So it's kind of ironic I'm showing you a time-based chart, but it just so happens that it works really well. So at 8:30, I'm not interested, and you'll notice there's just a lot of noise in here. So at 9:30, it triggers in, it comes up, and it just barely misses, and it's a losing trade. All right, it's going to lose 42 points. But I have a whole hour, and remember, I want to quit positive most of the time, so I'm able to take one more trade. And you can see that is what a catapult trade looks like. And I'm able to take 2 trades and quit with my positive result, and that's the goal. There are losing trades inside of winning trade plans. However, I'm just showing you the basics here. There are ways to clean this up, but the trade plan is 9:30 to 10:30, and I've found that I can quit positive a vast majority of the time with minimal and efficient trading with this and with the ES, using the exact same thing. Here's the ES. Just so happened the first trade on the ES did hit a target, so that was a winner right away, and you can see the second trade also. And again, look how accurate the targets are, because this is self-tuning itself. It's dancing with the markets. All right, I don't have anything complicated in here. Nothing. In fact, I don't even need to look at this histogram. Don't even need it. In fact, the histogram is inside the calculator, and you can turn it on or off as a filter. It's in there, trust me. And there's another filter in there too, the multi-trend. The multi-trend is what I call this presentation, and I don't even know if I'm gonna have time to show it to you. I do want to show it to you really fast. In fact, let me quickly do this Ranko thing and show you what I like to trade. So this is where you really see these beautiful moves. And if you could stay with the trend, another thing that I always teach is that action, reaction, subsequent action. And if you could trade the subsequent action, it's highly predictable and it tends to mirror the first action. So you have an action move up. You have a reaction that's into some sort of marker. Usually I use a 20 SMA, which I'm not showing. This is a 14 EMA, and that is what I have the trailer set to trail. All right, and then it trails a 3-bar stop. These are all things in the calculator that I can control. But notice that the subsequent action tends to mirror the first action. And if you learn how to spot these, see that? Look, it's almost perfect. If you learn how to spot these, you start learning how to find these kind of trades. And that could be your trade plan. So instead of a window of time, you could learn how to look for these sort of things. All right, a little more advanced. But this is what I like to do because I can't always trade the same time every day because, you know, I'm running my business also. So I'll often trade later. But I'll look for these opportunities. The other thing I love is when you cannot, you know, you break through barely. Sometimes it'll go a little further, but you break real strong resistance. And so a failure to move higher will often lead to a strong move in the opposite direction. And so I look for those. I'm not trying to necessarily make the move higher. In fact, after you see a couple strong legs, notice the third leg up is very weak, and then it consolidates. So I'll look for my action moves up, in this case, because it was trending up, starting to wane and get less, and that clues me in. And then if it pokes through and cannot continue to follow through, and here it poked through like by 1 tick, but a lot of times it might poke through a little further. It may even fail. It might just be like your classic 1, 2, 3 top, but I'll look for those. And then it's the trade in the opposite direction. And you could do some trend analysis. You can draw some trend lines, but you could also just use a setup that you're confident in and can test and prove to yourself, and it prints right on the chart and at the right edge, because this just happened probably, yeah, like right when I was tuning in, 11:30, I'm, you know, 9:30 West Coast time. This is right when I was tuning in to do my presentation. So this is, you know, as close to the right edge as I can show you on this chart. And it's the exact kind of trade I'd be looking for. And it was perfect. Look at target 3. When you start seeing that happening over and over again, you get a lot of confidence. Is that the same as pips? Well, the YM trades in $5 a point, and the micro, this literally trades in 50 cents a point. So, I mean, I can make this the YM and it'll look exactly the same. All right, it'll just change the amount of contracts. See, I can trade 33 micros, or I could trade 3, because I can't go 3.3 minis. So if I did 3 minis, I'd just scale out at target 1, target 2, and target 3, for example. But with 33, I could take 10 off here, 10 off here, maybe 5 off there, maybe 8 trailing. You know, I got options. I could save some, maybe I'll take some off if it gets to target 4. So that's what I like about being able to trade with the smaller increments. And that's what one of the good things about Forex, by the way, as you know, because Forex, you can go micros, minis, full size. All right, so quickly, I gotta show you the multi-trend because that was the title of the presentation. And I always talk from, I'm not using slides. I'm talking to you straight from my heart, straight from my brain. I'm not following a structure. I'm almost treating it like I'm in the trade room because it's just what I'm natural at it. I'd be fumbling around trying to follow a slide, and again, I'm the backpack trader. I'm freer than that. I hope you guys can appreciate that. But let me show you this, because this is a concept I think you're gonna love. This actually happened inside. This became what created the counterpunch trader. Have you guys ever heard of that? It sold like almost 2,000 copies in 110 countries several years back. There's still a lot of people using it. I use it to trade a crude oil inventory report every week in the trade room using Counterpunch Trader. All right, so I'm going to show you some of the elements of that and then how I've built it into Catapult. So first of all, the Counterpunch Trader stacks up a bunch of price action confirmations. What I didn't show you, of course, is that the entry here is below the setup bar, and a lot of times it'll cancel, because what we're asking is for the bar to push through the setup bar a little further down to hit the entry. And I could push that entry lower, like it's 2 ticks below the setup bar, but what if in some charts I might want it 5 ticks below the setup bar, see? And sometimes the price action won't be able to get through, and it'll turn around and go the other way, and the trade will cancel. And that's a good thing, because it would have been a loser. So price action confirmation is in every one of my strategies. There's also this concept of what's happening on the higher trend. What's happening on the trend 5 times higher? So if this is a 5-minute chart, which it is, wouldn't it be nice to know what is going on a trend of a 25-minute chart? And the thing is, with trend analysis, you have the long-term trend, medium trend, short-term trend. I'm interested in the short-term trend, but on a chart 5 times higher. And that became the basis for the counterpunch trade, which then became the counterpunch trader, with a full strategy. Like I said, I still use it many years later. Every week on the crude oil report, you can see my videos on YouTube. I got tons of them on there. Anyway, the whole idea is that you're seeing a downtrend on the higher time frame, but you don't have to look at another chart. All right, so then I thought, well, gee, this works so well, but what if I want to also look at the fast trend on this chart and the fast trend on a chart 5 times higher? And so I started looking at this, and it made me cross-eyed, but let me just show it to you. Oops, sorry about that. Turn it on. Looks a lot different, right? So one thing I noticed was, if you've got the slow line, the fast line crossing over the slow line on the faster, higher time frame, that if you traded the same direction up here, this alone makes for pretty nice trades sometimes. But what I wanted to do is use that concept as a filter for Catapult to help eliminate some noise, and that's what I did. So I'm giving you a real fast explanation because I'm running out of time. But I'm gonna show you this really fast, and it is called the multi-trend. And it takes those 2 histograms and puts it into one, and all you need to know is green means up, red means down, gray means flat, so that it matches everything else that's happening above. And you don't even have to look at it, because you can turn it on or off with the calculator. And if you turn it on, it's going to eliminate all the trades that don't match up with the multi-trend concept. All right, so that's what this will do. And these are all tools inside of the Catapult Trader, right? So the Catapult Trader can do a lot. Don't know what'll happen here, but we do see the market is oversold. And now we've got a long trade. Had a lot of V-shaped reversals. If you look earlier, a lot of these sorts of things going on. But you can see there's some really nice trades. And if the goal is to quit with a positive result a vast majority of the time with minimal and efficient trading, then a tool like this is going to get it done for you, even if you lose a trade or two, because of your beautiful risk-reward ratios and the ability to catch these catapult moves. You're going to be able to quit positive most of the time. That's what I teach, but I get into it in a deep dive with the boot camp that's coming up on May 28th. So I'm running out of time. I got 5 minutes left. If you have questions, type them in now, but let me just go back to the slides and quickly give you a few things. So there are some links I want you to click on. In fact, thank you, Anna. Anna just put in the chat a link for you to find out more about my boot camp. The boot camp is all about the Dowie Mini and Catapult. I just did one in the ES last month. It sold out. It sold out. I'm going to make it available now as a training with recordings, and I'll do a follow-up live training on it. It's not available at the moment, but the YM is a live one coming up, and it is 80% sold out. In the next week and a half, it's going to sell out. And so there's the link if you want to learn more about it. And then I also want to give you a free indicator, whether you join my boot camp or not, it's up to you. Like I said, I don't care. What I care more about is that you learn something from me today, that you like my way of looking at the market. I know I'm different. I know that when I present, it's not anything like what other people do. I don't want to be like everyone else. There's some amazing traders out there. I only care about freedom that I get by trading less. I want to trade less. And I want to show you how to do that too if you're interested. You can always trade more and still trade less, just duplicate more trade plans. But a trade plan is designed to help you quit with a positive result most of the time. You could prove it to yourself. And so you keep your money and you don't keep giving it back to the market. All right, so if you follow this link here, then you can get the free CCI custom indicator, the histogram I showed you with the oversold and overbought. Those horizontal lines, I didn't really get to talk to you about those, but you could use those as confirming indicator, confirming, you know, your trade setup. There are ways to do that, and that's why I'm doing the boot camp, to show you all these tricks that'll help you increase your percentages. But even if you don't know any of that and you keep it super simple, I mean, you can see the whole trade's right there for you. I mean, that just lined up a moment ago, right edge of the chart. Got lucky, it showed up here right near the end. You know your entry's at 23,936. You know that you can get out at target 1 and then move your stop to break even. That's going to make you 14 points. It's not that big of a trade. Let's see how the ES is doing really quick while I have another minute. Yeah, so the ES will be a little larger. And remember, these are micros. You could do full-size lots with minis, but look at the ES also. So that one made 1.5 points. Sometimes that'll be bigger. But someone is going to quit positive with this one trade and then go off and enjoy their day. Come back to it again tomorrow. So Anna, I got a couple minutes left. I want to thank you while I still have a moment for inviting me here. I always love talking about my stuff. I hope you guys enjoyed it. If you want to reach me, by the way, the best way to reach me is through my email. I answer all emails. I'm happy to talk to you about your trading. What time frames does this work on? Yeah, so I didn't show you momentum bars. It works really well on momentum bars. It works on, it's dynamic, so it will adjust. And it's also very new, so I've barely scratched the surface on what it can do because I'm seeing it work on swing trades as well. In fact, I'm trying to keep things really simple. Again, simplicity is one of the ingredients to success, but I know that there are different styles of traders. This will work across many different time frames. I like the 5-minute chart. I like a 14 momentum bar or range bar. I like the custom Renko charts I showed you and a bunch of other stuff that I'm just looking at going, wow, that works really good too. I can't wait to figure that out. But you know, there's only so much I can do, but there's only so much you need to do as a trader. You don't need to keep looking for stuff if you've already found it. How long will that link last? The MT4 question, when I come out with Forex over the summer, I will make this for MT4. So it doesn't work on it yet because this is the E-minis and MT4 is for Forex and this is futures. I am going to do an energy one too, probably for crude oil and unleaded gas, maybe natural gas. I'm working on these things, but you know, little by little, step by step. I want to deep dive and give you the best I got with every single thing I do. So I think my time is up. Anna, thank you so much.
All right, well, let me open up the question module here so that when all y'all ask any questions, I can see them. And let me expand this because we are live. So, hey, might as well do a little interaction here. There we go. Wow, we got a lot of people here. That's wonderful. Very, very nice. Good morning. Hi, Deborah Biofadre. You are everywhere I go. That is awesome. I love it. Okay, so let's see here. I've got audio, I've got recording, I've got screen. I think I'm ready to rock and roll. Oh, let's see here. One last thing. If I can, yes, bring up my little spotlight. Yeah, there we go. Oh, you know what? If I do that, then I can't change slides, it looks like. Yep. Okay. So that's all right. No problem. Oh, you know what I can do? I just want to be able to point. So I'm going to go to presenter view. There we go. And now in presenter view, I'll be able to point at things so that you're able to see what I'm pointing at here. All right, so today, as you probably already know, I'm going to talk about Fibonacci. I call this advanced Fibonacci made simple. So we're going to start with some basic stuff. And then for those of you who already know the basic stuff, maybe a few extra little distinctions. But then we're going to get into some more advanced Fibonacci things that perhaps some of you haven't seen before. So always fun to learn new things. So let's get this party started. So a couple of house rules. Number one, it says no questions until the end. You're welcome to ask questions anytime you want, but I just want to let you know that I am on a time schedule here, obviously, because of all of our other speakers as well. And so I've got 45 minutes, a little less than that now, and then I've got a hard stop at the top of the hour. So I'm going to stay focused on the presentation and make sure that we get through and respect everybody's schedule here. So if you would kind of hold your questions till the end, and I'll answer them then. Just make sure that we get through the whole thing. All this information is for educational purposes only, not investment advice, should be used at your own risk. Trading is extremely risky. The truth is most people do not make any money. It's a profession. And here at Top Dog Trading, we don't allow any get rich quick mindsets. So now that we've kind of got that established, again, I'm Barry Burns, owner and founder of Top Dog Trading. I'm the author of Trend Trading for Dummies. I've received numerous Reader's Choice Awards over and over and over, year after year. I've contributed to other authors' books, work with big companies out there. Here's just a few of them. Now, let's go through this fast. I don't want to sit here and talk about myself, but got some pretty good credentials. So let's talk about Fibonacci. So the first thing when most people think of Fibonacci are Fibonacci retracements. So let's start here and just kind of set the tone for how it's used by most people. And then we'll go into a little deeper dive. So this is how it's normally used. You'll have a Fibonacci drawing tool. You go into your drawing tools of whatever your favorite trading platform is. And then you draw a line. So when we get an impulse move from a high to a low, and then we move against that impulse move. So you'll draw a line, you'll click here, draw it all the way down, click at this swing low, and then it will automatically draw these horizontal levels at these percentages. So 0% means it's retraced zero, 0%, right? When it comes back to this line, it's retraced from here to the top, 23.6%, 38.2, 50, and so on. And these are often used for people who want to get into a trend on a trend retracement. That would be one application. As you'll see, there's many more. But that's one thing. So they'll look for these levels to be resistance. And where's the market going to go down? Well, it comes up to 23.6, doesn't go down from there. Green bars continue, 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 and then boom, we see a swing high here, and that turns out to be a resistance level at 50%. All right, so 50% of the retracement from the low to the high, that's where the market decided to find resistance and bounce off of that and go into the continuation of the trend. So essentially, Fibonacci levels are support resistance levels that we look for the market to put in swing highs and swing lows. It can be trend continuation trades, trend reversal trades, all sorts of things, but bottom line, they're used for support resistance. Now, how are these discovered? Well, talk a little background here. So Fibonacci sequence of numbers is named after Leonardo of Pisa, who is known as Fibonacci, which just simply means son of Pinocchio. And he introduced the sequence to the Western world in 1202. But even though he is widely attributed to having discovered this, and he may have independently discovered it, but it was used in India long before he was ever born. So, and that's kind of cool because what that means is it was discovered independently in several different parts of the world. And there's something to this. There's something to it. So what are these Fibonacci numbers? Well, there's sequence of numbers beginning with 0 and 1, and then each subsequent number is the sum of the previous two. So you see my little header here. That's actually the Fibonacci sequence right there. So the way that we figure these numbers, it's very simple, as I just said. So you get your 0, you got your 1, you add them together, you get 1. Okay, then the next thing you do is you take these two numbers, 1 and 1, off of the previous calculation, and you add those together. So 1 plus 1 equals 2. This is very advanced math here stuff. This is, you got to have a PhD from MIT to figure this out. All right, well, then we take these two numbers, the 1 and the 2 from that equation, we add those together, and 1 and 2 equals 3. So our sequence is 1, 2, 3. Well, so far, pretty darn simple. We can all count to 3, and as you see here in the sequence in the header, 1, 2, 3. Next one is 5. Wait a minute, all of a sudden we jumped. Where did we get 5 from? Well, because we go back here and we add the 2 and the 3. And when we add the 2 and the 3 together, now we get a 5. So the sequence is 1, 2, 3, 5. Add the 3 and the 5 together, and we get 8. And sure enough, there it is, 1, 2, 3, 5, 8. And then we add the 5 and the 8 together, and what do we get? 13. So 1, 2, 3, 5, 8, 13, and on it goes. 21, 34, 55. We're not going to do the whole thing. It goes on to infinity and beyond. All right, so that's the basic concept. Now, why are they considered significant? So what's the big deal anyway? Well, again, as I said, they were independently discovered in various parts of the world by geniuses working mathematically, studying nature, and just studying the world. And so what the people have found is that they are in the structure of multiple natural patterns. You know, nature can be analyzed with mathematics. Most everything comes down to mathematics. So they were found as an organizing principle of nature. So whether they studied flowers, fern leaves, the nautilus shell is probably the most common pattern that is referred to. Pine cones, cauliflowers, sunflowers, whatever, all these different patterns, physical patterns in nature. Okay, so that's the core of it. Now, let's talk about trading. So in trading, why would we use these? Well, in trading, sometimes the sequence is used. W.D. Gann was famous for using the sequence itself, these numbers. But for most people, and as I showed you on the opening slide, they're using the Fibonacci ratios and not the sequence. So what are the ratios? Well, each number in the sequence is approximately 1.618 times greater than the preceding number. And that's what they noticed. So somebody said, hey, what if we, so we got the sequence here, but, you know, and I showed you how they create the sequence, but that they said, you know, there's something kind of interesting here. As we go backwards now, and we divide one by the other, they all have pretty much the same division. So this number, the 1.618, is called the foundation of the ratios and called the golden ratio or the golden mean. So for most people who are Fibonacci purists, that's the number that they're working with. All right, so it could be 1.618 or 618. And then, so that's where we start. That's the key number. But there's other ratios. Two other key ratios are determined by dividing any number in the series by the number 2 places to the right and 3 places to the right. So let me show you what I'm talking about. All right, so 61.8%, that ratio is found by taking any number in the sequence. So here's our sequence, I put it up here linearly, and dividing it by any number in the sequence that is found one place to the right of it. All right, so here's what I mean by that. So here's 13. The number to the right of it is 21. So 13 divided by 21 is 0.619. Same thing here, 21 divided by the number to the right of it, 34, 617. Same thing here, 34 divided by the number to the right of it, 55, 618. Okay, so that's the thing that the mathematicians noticed is that, we created this sequence. We found this sequence of numbers that seems to be very significant in nature on the patterns as we analyze the geometry of nature. And then as we look at how these are related to each other, they're all about 0.618 apart when you go and divide them by the number that follows it. Now, then they said, well, what other stuff can we find out about these ratios? So they found in another key ratio is 38.2. And that's divided by simply taking any number in the sequence and dividing it by the number 2 places to the right of it. So instead of doing it one place, now we're looking at 2 places. So go back to 13 there, go 2 places to the right, 1, 2, divide 13 by 34, and we get our 0.38. Same thing, 21, 2 places to the right, 55, divide those two, 0.38. 34 divided by 89, 2 places to the right, 0.38. Huh, interesting. It's consistent all the way through. And then another ratio that we use, and we showed you these ratios on the retracement in the very first slide. We'll get to some charts. So 23.6, how is that determined? Well, guess what? By dividing any number in the sequence that is found 3 places to the right of it. All right, won't go into all the details, but again, just look at this one, 13 divided by 3 places to the right, 1, 2, 3 by 55, and you get your 0.236. So that's where these ratios came from that we use in retracements. All right, now 61.8 is the golden ratio, but there's others, as we talked about already, 38.2 and 23.6. Those are called secondary Fibonacci ratios. So we got our primary, our secondary. Now we got a couple of others though that I showed you on that chart, 50% retracement and 76.4 retracement. So where do those puppies come from? Well, 50% is frankly not a Fibonacci ratio at all. It's simply been observed that it is a common support resistance level, halfway between the high and the low being measured. And 76.4 is also not a Fibonacci ratio. It's simply the mirror of the 23.6. Right, so you add 26 or 76.4 and 23.6, and you get 100%. So there it is. Now, some traders, if they're real purists, they won't use 76.4. They'll use 78.6 instead, pretty close, because they say, well, that's the square root of the golden ratio, and therefore they're, sticking truer to maintaining consistency with it having something to do with Fibonacci. And that's fair enough. Now, this is in the general category of what's called market geometry. Market geometry. There's other aspects of market geometry as well. Gartley patterns, astrology, squares, all different types of market geometry. Today, we're going to keep it simple, and we're just going to use the following numbers and their extensions. So the numbers I already talked about: 0, 23.6, 38.2, 50, 61.8, 76.4, and 100. We're just going to use those and their extensions. So extension would mean 123.6, 138.2, 150, or you could even go 223, 338, 350. All right, those would be the extensions. So let me show you what I'm talking about here. So let's go back to kind of our original diagram here. We've got a swing high, we've got a swing low. That's your impulse move. Market retraces, and the question is, where is it going to retrace to? Where's the next swing high going to be put in? So just because it retraces to a Fibonacci retracement level, there's your 23, 38, 50, 61, 76. Just because it retraces to one of these levels, does that mean that it's going to hold that level? No. It is a potential resistance level. But here you see it slices right through, slices through like butter. All right, so now we go to the 38.2. Does that hold? Nope, slices through like butter. 50, does that hold? Yeah, that one holds. And then as we come down, get a little pause here at 38, but it actually ends up at 23, and that ends up being our swing low. Then we go back up to 50. Wait, doesn't hold it this time, but it does go to a Fibonacci retracement line. This time it goes to the golden ratio, 61.8. Stops there. Comes back down to 23, goes back to 62. So you can see these levels, they do quote unquote work. Now, we will get to the issue of how do you know which level is going to hold? But part of it, frankly, is just watching the price pattern. So again, I mean, there's no indication, just watching price bars, green candlestick, green candlestick, green candlestick, there's no indication it's going to hold there. So these levels are always potential support resistance. In fact, I mean, gosh, if it bounced off, the market bounced off every support resistance level there is, the market could never go anywhere, right? It's got to break through levels from time to time in order for it to move up and down, make higher highs and higher lows. So we never use support resistance levels as our only piece of evidence in trading. It's one piece of evidence as we put together a trading plan. It's one piece of evidence. Then we need to look at, okay, what's the strength of that market? Now that's where money flow comes in, the imbalance of supply demand. So is there still a lot of demand in this market as we come to this price level? Yes, there is. So therefore, it's not going to stop there. This price level, still a lot of demand. This one, no. Now, what's really happening behind the scenes is the supply-demand imbalance is shifting. And all of a sudden, people who bought, they're like, ooh, price is getting kind of high. I think I'll take some profits there. And maybe there's other people coming in who are saying, gosh, we retraced half of the move from the high to the low. That might be a good place to short the market. And so supply demand shifts, and that's the bottom line. That's what moves all markets, by the way. Very simple. There's nothing mystical about the markets. It's all about basic economics of supply demand. And these are potential price levels where the market participants, you, me, and everybody else, will change their mind from time to time saying, oh, now we think it's cheap. Oh, now we think it's expensive. You know, in a business, what is a product or service worth? Well, the common answer is it's worth what anyone's willing to pay for it, right? And that changes from time to time. And that changes. So the markets are very dynamic. So at one point, people might have more enthusiasm about a particular market, a commodity, a stock, a company. And other times, not so much. Or world events change people's sentiment or make them more fearful or greedy. And we've been living through that in a big way lately. Fear came into the market. Okay, and then market got very, very oversold, and people started saying, you know what? I think maybe we're through the worst of it. We still got some to go because, by the way, market always leads the economy. And so, sure, there were still things coming out that were bad news and so forth, but the markets are always anticipating what's going to happen in the future. They're never trading just the current price. Okay, so the next thing here is we get a Fibonacci extension tool. Now, this tool is pretty cool. So the retracement tool is basically where to get in on a trend retrace. Fibonacci extensions are great for price targets. People ask me all the time, where do I get out? How long is this move going to last? I want to stay in for, the big move. So we use a Fibonacci extension tool. This one is a 3-point tool. So we draw it from a high to a low, but then you draw it to the next high. You click there, and then this pops down for you. So you notice this one, we're already clicking here. We're not looking for the retracement. We're looking for the numbers below, in fact, even below this low, of how far this could go. So that would be 100% move right there. And what that means is from here to here is the same as from here to here. That's 100% of the move of that impulse move. That, by the way, is called a measured move. That is a technical term, a technical analysis, a measured move. When this moves down the exact same range that this moves down. So it moves down 23%, 38, 50, 61, 76, and finally 100. Okay, notice it bounced off 76, came back to 38, went down to 100, came back to 23, goes back down to 76. So these levels are being hit. And they work very, very well in conjunction with watching the energy of the market, meaning money flow, supply demand imbalance. Now, we can also look for clusters because you're going to have some market participants who are using Fibonacci retracements, and then others don't. Others use the Fibonacci extensions. So if you put both tools on your chart, what you're going to do is you're going to see support resistance levels from two different groups of market participants. And that increases your odds of finding support resistance levels that are really going to hold. Why? Because it's a self-fulfilling prophecy. People are watching those levels to buy off of or to sell off of or to take profits into. And the more people you have who are seeing a level, the more people who will respond to that level in one of those three ways. So now they don't all have clusters, right? So we drew a cluster here. So first of all, from that low to that high, and that created these retracements all the way back down to 100 retracement. And then we drew our extensions from that low to that high to that low, and these are those numbers. So we get a cluster here between the 76 and the 38. We get a cluster in here of the 100 and the 23. And you notice the markets kind of consolidate around this. Why? Because it's a point of indecision. Again, should I buy? You know, market doesn't feel as comfortable. Market participants don't feel as comfortable of just, slicing through those levels. Hesitation comes in. That's the psychology behind it here. Because people are like, well, I don't know. I'm not sure. What do? People who are uncertain tend to do nothing. They tend to not buy. They tend to not sell. And the market just goes sideways. So Fibonacci cluster is a very good thing to add to your trading. Now, let's talk about something that very few people talk about. This tool, Fibonacci time extensions. So notice these lines are not horizontal, these are vertical. It's very interesting to me that very few people talk about time with relation to technical analysis. We're always talking about price. And you should. Price is very important, obviously. It's super important. But if you think about it, a chart is a two-dimensional object. It has two axes, price over here and time on the bottom. And that's it. A chart's a two-dimensional object. So if, like most people, you ignore the time element of the chart, what are you doing? You're missing out on 50% of the information on a two-dimensional object. Well, since trading is all about establishing a probability scenario, how in the world can you establish a probability scenario if you're ignoring 50% of the information? Right? Doesn't make any sense. And so, in fact, W.D. Gann, the famous trader W.D. Gann, he said between the two, time is actually more important than price. They're not even equal. Well, that's up for debate. You may agree with that, you may not. I think they're just both important. I want to use them both together. It's it's at least half the information on the chart. And by the way, when you think about it, what's trading all come down to? It all, after we put together all the different cool indicators and price patterns and candlesticks and moving averages and everything else, it all comes down to two things. When do I get in and when do I get out? Right? I mean, that's trading in a nutshell. Two things. When do I get in? When do I get out? And the word when is a timing word. And so maybe W.D. Gann was right. Maybe time is more important than price. Anyway, we put the two together, and I'll show you another way to do that here in just a minute. So this tool, Fibonacci time extensions, and again, just go to your drawing tool in your toolbar, whatever charting platform you're using, and you'll see what drawing tools your charting platform has. Some have these, some don't. Most of them, I think, do these days. So this draws vertical lines because it's measuring time instead of horizontal lines. It's not measuring price. Now you notice we got the same percentages, 50, 61.8, 76.4, 100. Now, this is time extension. So this line is here, this black line, because I drew it from that low to that high. So you can see where I drew the line from the beginning to the end. So what we're really doing is we're looking now from this point, that was the hard red edge of the screen. And then we're looking for places in the future where we could get swing highs and swing lows. So at 123.6, pretty good. By the way, any support resistance level, we draw them as lines. They're really zones. So look for it to come in within 1, 2, or 3 bars. Don't expect it's going to come into the penny, the pip, to the tick, the exact bar. That's unrealistic. If you're in there within a bar or 2 or 3, you got it. You nailed it. So right around this time, we would say, again, time, we would say, oh, I'm expecting that we might put in a cycle high or low at this time. And sure enough, we do. It goes up. Again, comes into 138.2. Ooh, here's another time when we should look for a swing low. Yep. Here's another time, 150, a time we should look for a swing high. Yep. 161.8, a time when we should look for a swing high. Yep. Now, I would never use this alone. I use it in conjunction with other tools. Again, it's one piece of evidence. Also, it doesn't catch every swing high and low. So notice, for example, this high. Didn't catch that one. Is that okay? Sure. Nobody catches every swing high and low in the market using any tool. And that's fine. This is under the auspices of what we say, make the market come to you. And what we mean by that is it's the opposite of chasing the market. So we created trading strategy, a trading system, and then we just trade that system. And when the market comes into our rule set, that's when we take a trade. The rest of the time, market's going to do all kinds of stuff. It's going to do what it's going to do. It's going to go up. It's going to go down. And other people might make money on that stuff. And that's fine. Maybe that's when it comes into their trading rules. Hey, let them have their money. That's cool. You can't, keep all the money to yourself. So let some other traders make some money too. But we have our set rules, objective, rule-based methodology. When the market aligns with it, that's when we take our trades. Okay, and again, this would be one more piece of evidence that we could add to our complete trading methodology. Now this one's really cool. So this is called Fibonacci circles or Fibonacci arcs. They're both the same thing, but it can be called one or the other depending on the charting platform that you're using. So they're really circles, but the reason that some charting platforms call them arcs is because they look like arcs because you don't see the whole chart. Now, if I was to zoom out, this is not a live chart, obviously, it's a slide, but if I was to zoom out and see the whole thing over a large period of time, you would see this is actually a complete circle. But then our chart gets really small, and so we see the arc of the circle. Okay, so what we do is we draw it from, again, another major swing high to another major swing low. Now, what's cool about this is it measures both time and price in one tool. So it pulls together both axes of the chart and measures both time and price with just one Fibonacci tool. And that's why it's curved. So over time, where that line is varies. Here it's there. At this time, it's there. At this time, it's there. Okay, at this time, it's there. At this time, it's there. At this time, it's there. And same with price. At this price, it's way over here. But at this price, it's over here. So what we do is we look for price to go up and ride into this arc. And again, once it gets into that, we look for a swing high. So we're combining time and price. At this time, at that price, we're looking for a swing high. Comes back into the next arc, boom. At this time, at this price, we're looking for a swing high. So pretty cool. Very rarely do you see this. By the way, a little extra tip on this that's super important. This is a dynamic drawing tool. And what that means is you must set your scale of your chart before you draw this tool and then not change it. If you change the scaling, like if you go in here and you change the scaling up and down or on the time or whatever, these lines, these arcs will move. So you can't do that. You got to fix the scaling. Otherwise, the arcs move and they become meaningless from where you first drew them. Okay, as I said, these Fibonacci tools are just one piece of evidence. But what else do we have to use? As I've already kind of implied, we look at the energy of money flow in the market. So it's one piece of evidence. What else do we need? Well, I use 5 pieces of evidence, and I talk about the energy in the charts. When I talk about the energy in the charts, I'm talking about the energy of money flow. That's what I mean by the energy of money. So the first thing I look at is trend. I use the 50-period simple moving average for that. The second thing I look for is momentum. Use a momentum indicator that tells us the strength of that trend. And then I use an oscillator to measure cycles in the market. And so we look for the cycles to come into the support resistance. Now, number 4 is support resistance. That's what we've been talking about. So all these Fibonacci tools fit into step 4 of my 5 energy trading methodology. Those fit into the category of support resistance. Most of them are price support resistance, which we're used to. And then I introduced you to a couple of tools that also give you time support resistance. Very few people ever talk about support resistance as related to time, but there's support resistance for time as well. And then the 5th energy is I look at the next higher time frame, make sure that we're aligned on both time frames. So my 5 energy methodology is based on statistical probability. At each point, we're simply asking ourselves, how many of those 5 energies of money flow are aligned? We give each setup a score of 1 to 5. Pretty simple, just counting to 5. The higher the score, the higher the probability of the trade. It's kind of like taking each trade to court. We need 5 independent witnesses to establish a preponderance of the evidence. Remember, nobody knows the future. Nobody's got a crystal ball of the market. We are trading statistical probabilities. How do we do it? Well, this is how I do it. 5 uncorrelated pieces of energy. So, and energy again basically just refers to money flow. So energy number 1 is trend. I just use very simple stuff, by the way, nothing complicated. 50-period simple moving average, intermediate trend indicator. As long as it's angling up, indication is that the trend is up. Some people say trend is defined by higher highs, higher lows. I don't really like that definition too much. I mean, here we have a lower high and a lower low, but I would never say that's a downtrend. That's just a complex retrace in an overall uptrend. Because a trend is defined as the general direction of the market. In fact, Webster's dictionary is literally defining it as the extended general direction of the market. But I'm not trying to be a stickler for the English language here. It's just that from a trading point of view, we want big rewards. And so you got to have a long-term trend for that. Momentum is the energy of the trend. So for example, we can have your higher highs, your higher lows, higher highs, higher lows, and momentum is supporting that all the way until there. So this is the great thing about momentum. Momentum actually can lead price trend. So we're moving up on strength as defined by momentum. And now we're moving up on weakness. So sure, price is a higher high, but it's moving up on weakness. Lower high on momentum. That means now the money is shifting from the strong hands to the weak hands before it shows up in price. You see it there first. And so if you're in this trend and you get to there and you see this, either get out or go short. Either get out or go short. Same thing here. Even though the market's just kind of moving sideways, again, a little bit of a higher high, but oops, lower high in momentum shift, we call that. Time to go short. I'd rather trade in the direction of momentum than trade in the direction of trend. Ooh, that's a tricky one. Cycles. Cycles high, low, high, low, high, low. This is the oscillation of the market, almost like the heartbeat or the rhythm or the breath of the market. Inhale, exhale, inhale, exhale, inhale, exhale. It's almost like lifting weights. All right. And so now cycles, they indicate timing, but they don't indicate range. So for example, we've got a cycle low, cycle high, cycle low, cycle high. Doesn't go very far. Well, that's because cycle doesn't indicate momentum. See, each of these 5 energies are uncorrelated to the other 4. Each one serves one purpose. And because they're uncorrelated, by the way, they have to be uncorrelated, otherwise you don't give yourself a probability scenario, right? If you put 5 trend indicators on your chart, you've got a 1 energy method and you don't have a statistical probability. That'd be like putting 5 speedometers on the dashboard of your car. It measures the energy of speed. None of us would do that. So this only indicates timing, but we need trend for direction, momentum for strength. And then our good old support resistance, we've already talked about this. So here we're in a downtrend. So we are just looking now for retracement in a downtrend. We're looking to go short. Same thing here, made a little bit of a higher high, but trend is still down. By the way, this is called my rubber band trade. I'll give you guys the rubber band trade for free today. How's that? I'll give everybody who's here the rubber band trade for free. And these are just beautiful trades. The basic pattern is price above a downward sloping 50 MA. That's what that red line is there. That's the 50-period simple moving average. We look for it to come to retracement and then go down in the direction of the slope of the 50 MA, but it's got to be above it. And my goodness, those are just huge win-loss ratio trades. The key is here again, momentum. Momentum is very low. See here, we had strong momentum down, way below zero, way below zero. Here it's just kind of hovering around zero, and that's what makes it hold resistance. Remember I said, well, sometimes it holds resistance, sometimes it doesn't. How do we know which Fibonacci level is going to hold? The momentum is the answer. You need strength to break through. We don't have strength, therefore it holds, and momentum continues to the downside. And finally, the fractal energy, where I look at multiple time frames. So I look to the next higher time frame. We've got a nice trade here. First retrace and a new downtrend. Look, there's your cycle. Momentum's below zero. Awesome. Then we look over to the next higher time frame. Momentum is down. I've got to have this. Got to have that. That actually has veto power. So this method's very robust and very adaptable. It works for any market because all markets function on the basic core principle of supply demand. That's it. I don't care if it's stocks, commodities, options, currencies, futures. All markets work that way. And that's all we're doing. We're looking for that energy of money flow, which again is basically imbalance of supply demand. So whether you're investing, swing trading, day trading, we're working with that core principle of basically simple objective scoring of the 5 uncorrelated energies of money flow. So here's what I got for you today. I kind of dropped the ball. I hope you're not mad at me, but I don't have anything to sell you. So I kind of messed up, but I do have something free for you today if you want some free stuff. So I mentioned in passing real quick my rubber band trade, and that's what I've got for you today. So I want you to start making some money before you spend any money. You like that idea? Yeah, let's make some money before we spend money. So get my rubber band trade. It's a trade strategy I still trade every single time it sets up to this day. Been trading it for years. One of the reasons I give it away is because it's one of the simplest trades I have. It's got one of the highest win-loss ratios, and therefore when I give it to people, most people are able to succeed with it. And then they come back and they say, "God darn, Barry, you made me money. I love you." It's kind of funny how people like you when you make them money. So that's what I want to do. Just make you some money first, rubber band trade, go get it. Included in that will be a little mini course, make money by breaking every trading rule you ever learned. This is why most amateurs lose money, is because they're trading the classical rules. You get some videos, you get interactive quizzes, and also I've got a follow-up webinar that I'll give you my cycle indicator, the timing indicator. So you just go on over to rubberbandtrade.com. It's that simple. And we'll give that to all y'all. So I know I've only got like 2 minutes left. So let me just type this in here. And if anybody has any questions, this would be the time until Anna cuts me off here. Let's see, rubber band trade. I'm going to type this in bandtrade.com. Ah, there. Okay. www. Whoops. Rubberbandtrade.com. Manually typing. Not a very good typist, obviously. Okay, so let's see what kind of questions we have here. Oh, thank you. Yeah, Wealth 365 was good. Do you have time? Wait, let's see. Do you have to draw the time extension line sloping upward? Let me think here. Time extension line sloping upward. You can do it either way. Either way, you do it in the direction you're trading because you're drawing it for targets, for profit targets. So yeah, whichever way you're trading, long or short, you draw so you get profit targets ahead of that. Do I cover all 5 energies and scoring in the rubber band trade video course? No, I do not. I just give you enough because that's my whole 5 energy method methodology is available. But that's, that's a more in-depth course. So what I want to do is just give you a good setup here. That's very simple. And like I say, that one only takes 5 20-minute videos. So you can breeze through that. Let's see. Do you use fibs with Wyckoff? I do not. I do not. Not saying it wouldn't be a good idea. I just don't do that. Barat, can Fibonacci indicators can be applied to volatility? Let me think. I don't use them for that. That's an interesting question. I prefer personally, this is off, well, it's not off topic because it's your question, but I prefer to use moving averages and Bollinger Bands with volatility. Yeah, but I've never tried it with Fibonacci, so it could be an interesting experiment. But yeah, for me, the Bollinger Bands and the moving averages are really all that I need. That might be a nice, interesting experiment. Mm-hmm. All right. Wow, I think I've reached my exact minute that I'm supposed to be done.
Thanks to everyone who attended today's show. Don't miss our next events on May 14th. Follow us on Instagram, Investor Express, to find out more about our upcoming events. Once again, thanks to everyone. Happy trading and stay safe.